Happy morning, people. So yes, let's continue our marathon discussion further. So today the topic that we're going to be taking up first is accounting standard 10 that talks about property, plant and equipment. It is that earlier we used to call it as fixed assets. Instead of fixed assets, now the name has been revised and made as property, plant and equipment, or in short form PPE. So AS10 gives the complete guidance as to how this property, plant and equipment should be valued, disclosed, etc., etc., etc. Right? So let's dive into the first component. One, sir, this accounting standard 10 is not applicable for few assets. One, it is not applicable to something called biological assets. Biological assets means living plants and animals. The living plants and animals we refer to as biological assets. AS10 does not account for it. In Inter, we don't have an accounting standard for it, but in CA final, we have Ind AS 41 called agriculture. That talks about accounting of biological assets. Since there is another standard giving treatment for this, accounting standard 10 kind of takes a backseat. So it does not earn. Okay. Alright. Another one is exploration assets, like your coal mine, gold mine, mineral ores, like these. If you have, we call it exploration assets. We have Ind AS 106 for in CA final. Right? Since we have another standard for it, again, these are excluded. So these are the exclusions. They are not that important, but since we have an MCQ in our pattern, even these things also can be considered. Okay. I'm going to framing the question. Now, if you want to call a component an asset as a PP, if you want to call a component as a PP, there are three definition criteria which should be satisfied. One, it should be a tangible asset. It should be a tangible asset. Tangible means it should be able to touch, see, and feel. That is one. Second one, it should be held for use. That PP should be used for something, and usage should be one of the four purposes. Either to produce goods, or render a service, or administrative purpose, or rental purpose. For one of these four purposes, you have to use that PP. Producing goods is pretty much straightforward. You use Act 3 is used to produce goods. Like your Pro, we are using Act to give you recorded classes or some service, or track your attendance, etc., etc. So PP should be used either to produce goods or to give some service, or for administrative purpose. Administrative purpose means, so there are many property, plant, and equipment or fixed assets which cannot be directly used for production. Like Pro, if you think about it, we have AC in reception. We have AC in the reception area, lobby area. Are classes being conducted there? No. I mean, is that particular AC used to provide any service? But still, are they necessary? Yes. So that comes under which category? Administrative. So even if you are using a fixed asset for administrative purpose, it is acceptable. Okay. The last one is rental purpose. You can rent a plant and machinery or fixed asset to somebody else and earn some rental income. For one of these four purposes, compulsorily it should be utilized. Is that okay? And that usage should be for more than 1 year, as in 12 months. So again, what are the three components? One, it should be a tangible asset, meaning you should be able to see, touch, or feel. It should be held for use. The usage should be either to produce goods, or render service, or admin purpose, or rental purpose. And that usage of property, plant, and equipment should go beyond 1 year. Okay. So if these three are satisfied, then an asset comes under the definition of what? PP. It comes under the definition of PP. But if you want to show that PP in balance sheet, there are two more recognition criteria. There are two more recognition criteria which we use to call as FEB and cost measurement. FEB and cost measurement, meaning FEB as in future economic benefit. Future economic benefit, meaning from the property, plant, and equipment, you should be able to get some benefit. Now, why do you think we have purchased iPad? Why do you think we have purchased an iPad or laptop or not? So that we can give some service and we can earn some money from that service. So from the PP, you should be able to get some benefit. It's not necessary that you should get the benefit immediately. If the company feels they will get the benefit after 1 year, after 2 years, after 6 months, that is also fine. And cost measurement. Should be able to get some benefit. Now, why do you think we have purchased iPad? Why do you think we have purchased an iPad or laptop or not? So that we can get some service and we can earn some money from that service. So from the PP, you should be able to get some benefit. It's not necessary that you should get the benefit immediately. If the company feels they will get the benefit after 1 year, after 2 years, after 6 months, that is also fine. As long as there is a benefit expected either currently or in future, it is acceptable. Okay, G? So this is the one of the recognition criteria called FEB. Don't use short forms in exams. These are just for the remembrance sake. Another one is cost measurement. How much money we spend for that PP, you should be able to measure it. So basically, if PP has to appear in balance sheet, how many criteria should be satisfied? 5. 3 definition criteria, 2 recognition criteria. So all the 5 are satisfied means PP will appear in your balance sheet. Otherwise, how much ever you have spent will be transferred to P&L. If these criteria are not satisfied, how much amount you have spent will be straight away transferred to P&L. Are we okay with this? Coming back to the next one. As I said, biological assets means living plants and animals. Okay, but there's one small exception to this. First of all, go one step back. For biological asset, AS10 is applicable or not applicable? Not applicable. And biological assets means what? Living plants and animals. But there's one exception to this biological asset called bearer plant. Bearer plant, meaning exception of an exception is applicability. Exception of an exception is applicability. Like maths we say, negative and negative when you multiply becomes positive. No? Here also same grammar. Exception of an exception becomes applicability. Meaning for bearer plant, AS10 is applicable. For other plants and other animals, not applicable. Is that okay with you? Okay, that means we need to know what is meant by now. Bearer plant. If you remember our regular class, I should give mango tree example. All in simple terms, I'll probably in interest of time, I'll quickly tell you. First, maybe I'll call out the conditions for you. If at all you want to call a plant as a bearer plant, three conditions should be satisfied. All the three conditions should be satisfied. One, that plant should be used in the production or supply of agricultural produce. It must bear the produce for more than 12 months. It has remote likelihood of being sold as agricultural produce except for incidental scrap sales. That is the exact criteria. You don't have to mug up all this. If you know it, awesome. But what usually gets asked in examinations, at best, these are not too much targeted. They may give you some criteria and they may say whether it's a bearer plant or not a bearer plant. You may have to just identify. But if you can remember, it's good. Why do I say that? Accounting standard 10 at CA intermediate. In days 16 at CA final, ditto. Not even 1% change. This standard, if you learn properly, next topic of CA final, you're covered. Except that few questions are not tested at CA intermediate level, few big questions are tested at final level. But conceptually, you'll not learn anything extra. Maybe one or two extra best. So that way it's good to know is what I feel. But rest I'll leave it. Okay, Naji. Now coming back, bearer plant. What is the first criteria I said? It must be used in the production or supply of agricultural produce. Common sense. From that plant, you should get agricultural produce. From that bearer plant, you should get agricultural produce. Now let's see if mango tree can be called as a bearer plant. Can a mango tree be considered as a bearer plant? From mango tree, you get apple. What do you get? Mango. Mango is factory produce or agri produce? I mean, first criteria, fast. Because you're getting agri produce called mango. Second one, it should bear the produce for more than 12 months. Meaning from that tree, you should get produce not just for 12 months, but for more than 12 months. Because PP means you'll use it for less than 1 year, more than 1 year, more than. Now, if you want to consider bearer plant as a PP, then that you should get mangoes for less than 1 year, more than. If that mango tree gives you mangoes for more than 1 year, then we say second criteria is satisfied. Understood? Third one is what? Basically, now if there's a farmer is upkeeping the mango tree, let's say, what do you think farmer business is here? He will sell the mango tree or he will protect the mango tree. He will try to protect the mango tree and sell only what? Mangoes, correct? But suppose there's another farmer. You know what his job is? He'll put mango seeds. Once mango tree comes into picture and mangoes are extracted, farmer does two things. You know what he does? He collects the mangoes. After all the mangoes are collected, he will cut the mango tree and sell it to the wood industry. Because for furniture and all you need wood, no. So his business every year is this: sell mangoes, cut the mango tree, and sell mango tree also. I mean, he's selling two things normally. What are those? Mangoes and mango tree. That should not be. Because now do you think you will sell iPad every year? No. Only if iPad starts acting weird. If it is not performing properly, then only we will sell. Meaning, you should only sell it as what sale? Scrap sale. Regularly, you should not sell the tree. Regularly, if you are selling the tree, sorry, boss, it is not bearer plant, it becomes your inventory. What you sell regularly is not property, plant, and equipment. That is your inventory. These are the three conditions that they talk. Manageable. Then you want to say what are those? If you want to call it as bearer plant, from the plant you should get agri produce. And you should get that produce for less than 1 year or more than 1 year. More than 1 year. Third one, the tree should be regularly sold only as a scrap sale. Only as a scrap sale. If these three are satisfied, then a plant becomes bearer. Usually mango tree, apple tree, and all this satisfies this criteria. So it comes under which category? Bearer plant. And if it is bearer plant, AS10 does not apply or it will apply. It will apply. What next? Okay, RC we have already seen as a definition criteria. Okay, next one is spare parts and standby equipments. Now people, we have inverters and generators. Every office will have either an inverter or they'll have some generator. Will we use it daily? Will we use the inverters and generators daily or only in emergency case? When there is a power cut, only then we will use inverters, right? They are all known as what's a standby equipment. Now we are trying to test, can we consider standby equipment as a PP? Can we treat standby equipment as a PP? AS10 says yes, standby equipment also can be considered as PP provided conditions are satisfied. Three definition criteria and two RC criteria. Usually they say definition criteria is satisfied, then you can show it as PP. If it fails, show it as inventory. That's all. This is the classification recommended for spare parts as well as standby equipment. Spare part means. Now you know I'll give you another example. This pen is there. No? This pen is there. The pen is still on for a long time. But no, many faculty will be in Josh. Passionate. Suddenly it fell off. My hand went fell off. It has happened. No, it does not happen. They put tax on me. Okay. So this nib, no, so it's quite sensitive. Nib is quite sensitive. Maybe if there's a hard drop, if it falls from a big distance, do you think that nib will work properly or going down? So we have kept some spare parts of nib. We have kept some extra nibs. So when this gets damaged, we will throw the pen or we'll only replace this. That becomes what? Spare parts. Okay, like this many organizations, no? When there are some big assets, they like to keep some spare parts so that the business should not get affected. Criteria for that is also same. If RC is satisfied, meaning definition and RC is satisfied, then you classify it as what? PP. Otherwise classification will become inventory. That's all about this. Move on. So okay. Next, replacement of parts. Replacement of parts. So if you replace one part, okay, you're not selling the whole asset. You're not selling the whole asset, but a part of the asset is getting replaced. In that case, what we have to do? If you remember our regular class, I used to give this electric car example. Okay, but anyway, I'll take you to the same example once again. Let us say I purchased electric Bundy. Life how much? 10 years. How much cost? 15 lakh. So I paid 15 lakh and I purchased an electric car. I'm expecting this car to last for how many years? 10 years. But that vendor from whom I purchased, he told, boss, car is super. Car is amazing. Good choice. But battery you have to replace every 5 years. Battery you have to change every 5 years. I asked how much battery? He told 5 lakh will be a battery cost. Because electric car, big cost is towards battery. So out of 15 lakh that I have paid now, how much is for the battery? 5 lakh. That means how much is for the others? All other parts like steering wheels, major engine will come for how many years? 10 years. But battery alone, I have to replace after. Is that okay? Possible. This can happen. Now, okay, I said no problem. Give me the car. We will make the deal. So I paid the money, got the car. But look at my was. After 3 years only battery gone. After 3 years only battery gone. It's not working. Sir, I was expecting the battery to go for how many years? 5 years. But depending on our Bengaluru, Chennai road condition, okay, potholes, things like that. The battery lasted only for how many years? I think Chennai is better. Bangalore, only. Okay, most of the time we drive in footpath only. Because so much of potholes and so much of traffic, people are finding like squeezing everywhere. Compared to their phone to Chennai, traffic will be better. I'm not roaming around too much, but wherever I have roamed around, I feel this is more peaceful. Okay, but anyways, okay, now coming back to the example. At the end of year 3, what happened? Battery gone. Now what I have to do, sir? At the end of third year, what I have to do? I have to replace, I have to buy a new battery. Now, two things, two questionable things are coming to picture here. One, you're buying new battery, right? When? End of year 3 or beginning of year 4. Now, first question is, what should we do for new battery cost purchase? Let's say I spent about 5 lakh rupees more to buy a new battery. What should I do for that 5 lakh? Should I add it to the cost of PP, that is electric car, or that new battery car 5 lakh cost I should transfer it to P&L? Do you understand? The new battery cost I should capitalize and add it to the cost of PP, or should I transfer it to P&L? Question number 1. Second question, what should I do for the old battery? What should I do for the old battery? I get the 2 points over here. So these are the 2 points which accounting standard 10 is trying to address. Okay, not only that concept only calling what's a replacement of parts. Okay, so if I pretend the provision in one liner, what accounting standard 10 is saying is, if you're replacing any major part, then you just check if RC is satisfied. If the new part satisfies RC, what is RC? Feb and cost management. If that new battery satisfies the recognition criteria of future economic benefits and cost management. If the new part satisfies RC, then the new part cost you capitalize. New part cost you capitalize, meaning don't transfer it to P&L, but rather add it to the cost of P. Is this okay? And standard also says, is the old battery there or one going there? Is the old battery there or one? So in car you fit 2 batteries. Now when old battery is gone, you will remove the old battery physically and replace it with what? New battery. That means in that car, old battery is physically present or taken away. Yes, you remove it. So physically, if you're removing old part, books also it should be removed. Books also it should be removed. That's what standard says. Carrying amount of old part, if at all, if it is remaining, remove or derecognize. So two components. What are the things I said? New part का cost you add, provided RC is satisfied. Old part का carrying amount you remove. So one addition, one subtraction. That's all you have to do. So how many old part are carrying amount, sir? Okay, look at this. Let's work it out. Do this. So how much did I spend for buying the car? 15 lakh. In this 15 lakh, how much is towards battery? 5 lakh. How much is towards other part? 10 lakh. Right now. Now battery I thought when I purchased, it lasts for how many years? 5 years. Others I thought will last for how many years? 10 years. What standard says here is, so normally till now we used to calculate depreciation on what amount? Till now we have 11th grade. Now we used to calculate depreciation on the total amount. But ACE says, accounting standard 10 says, if different parts have different life, if different parts have different life, calculate depreciation separately. Don't calculate depreciation on 15 lakh. Calculate depreciation on 5 lakh separately, 10 lakh separately. Why, sir? Because these two life same are different. This is okay with you. This week in standard terminology we call it as component accounting. It's not tested too much at your level, but just saying for your reference, it's called as component accounting. Meaning different components, meaning different parts have different life. Then depreciation also should be calculated separately. Okay, Anji? Now let's calculate depreciation. Straight line for MEㅅCA formula. What is straight line MEㅅCA formula? Cost to, I think I clarified that in class, not cost is actually carrying amount. Anyways, no problem. Cost to carrying amount minus residual value divided by life. Okay, let's calculate this. Okay, so when in my example, when are you replacing the old battery? Third year ending. So 3 years you have used old battery. So let's calculate depreciation for old battery for how many years? Please calculate how much is the battery carrying amount of original cost? 5. Minus what? Residual value. Have I given you any residual value? No, not given you this. 0. Divided by life. What was the total life expected initially? Right, so divided by 5. If you do this, what are you going to get? If you do this, you'll get battery for 1 year. You'll get battery for 1 year. I've used the old battery for 1 year or 3 years. So if you want 3 years for depreciation, multiply by 3. How much are you going to get? 3. So initially I paid for the old battery how much money? 5. How much has got depreciated? 3. How much is still remaining? This we call it as carrying amount remaining of the old. Carrying amount remaining of the. This is what we should do. Can you still show it or delete it? This you'll have to minus. This we'll have to. And new battery cost. New battery cost. Let's say new battery cost is 7 lakh. Inflation. 5 years back it was 5 lakh. Means as the years progress, the value of the price of the product will increase. Let's say the new battery cost how much? 7 lakh. What will you do for this? New part cost you will add. Old part carrying amount you will here. Suppose if this has become 0. Suppose this has become 0. Then should we have to do any adjustment or not? Yes. So when will it become 0? Suppose battery lasted. Old battery lasted for 5 full years. Old battery came for how many full years? 5 full years. Now calculate 5 lakh original cost minus residual value 0. Divided by life was how much? 5 years. I used it for how many years? 5 years. I mean this will be 3 lakh or 5 lakh. I mean this will become what? In that case, we should have to do anything. That's all. Okay, people. If at all any carrying amount of old part if it is remaining, remove it. Because physically the battery happened. Hi guys, we have exciting news today. If you look at Ayurveda, we have been always been innovating. We concentrate on this. So, okay, people. So that's all the wonder. The same concept holds good for what? Major inspection notes. This replacement concept and major inspection concept are same. So what is the whole concept again? New inspection charges you add. Carrying amount of old inspection you minus. So what is this inspection, sir? Some major assets like aircraft, ship and all, especially aircraft, right? Now you are taking people from one location to another. Sir, safety is very, very important. Now if you say like no, I will not check the safety. India's population is too much. No. Big deal with 200 people. Swarga means okay. Rail means okay. No. Can we approach business that way? No. So usually what government will tell is if you are in that industry, you have to do a thorough inspection of your aircraft because you are paying the people's life. So all this will not be small amount. All this amount will be on the bigger side. Every nook and corner, every nut to bolt and all will get inspected. Thorough inspection you should do. Maybe once in 3 years, 5 years, you'll have to do it. Okay. So hence this will not be a small expenditure. It will be a large expenditure. So the concept of the replacement part and major inspections are pretty much the same. Wait, carry on. Carry on. Pakana. It usually inspections will not have carrying on unless your aircraft met with a sudden accident. Then the government may tell you initially government would have told get the inspection every 5 years. The aviation ministry would have told to get your aircraft inspected every 5 years. Third year no, you send 100 people to Kailasam into Bay of Bengal, your aircraft. Now what do you think government will do? Check all your inspections. Check all your aircraft. When? Third year. So in that case, old inspection charges might have carrying, but usually it will not have. But if I call it the same concept. Okay, moving on to the next one. Sir, initially I have to show PP at what value in my ledger. I should pass the journal entry for PP for what amount? That is the concept. And we call it as initial recognition of PP. 3 things you should keep in mind for initial recognition. As a thumb rule or as a basic rule, initially every property, plant and equipment, doesn't matter whether it's furniture, machinery, aircraft, ship, whatever. Every property, plant and equipment or every fixed asset will get recognized at cost. Every asset will get recognized at cost. Cost for this purpose can be categorized into 3 things. Okay, one is your purchase cost, another one is your DAC, another one is your DSR. These are all short forms we used to use in our class. I tell you in case you are comfortable with those terminologies. Okay, what did I say? Initially all PPs are recorded at cost. Cost for this purpose will include 3 things. One is what's purchase. So if purchase cost is a major part of cost. So if you want to show PP first, you have to purchase. So this is self-explanatory. Yes, purchase cost will form part of cost. Now when you purchase a fixed asset, Nirmala Sitaram will come to the picture and say, give me GST, give me tax, okay, customs duty, GST, many things will get attracted depending on how you are buying it, where you are buying it. Yes, now what should we do for that tax? We have paid. We have paid. Should we add that tax to the cost of PP or should we exclude it? You got the question? So what AS10 says is, if it is a non-refundable taxes, meaning if you don't have input credit, if you can't claim input credit, then only you can add. If you are able to claim the credit, don't add. That only calculates what's a non-refundable tax. Meaning, or another, if you've got a tax, so on one hand I am paying GST, on another hand I am collecting the GST back. On one hand I am paying, on another hand I am collecting. That becomes a refundable tax. That you cannot add. I just paid. Like me, when you buy a mobile, you pay only for the mobile or you pay GST also? You pay GST also. Did you get it back? You got mobile? Did you get your GST amount back? I mean, for you, the GST is what? Non-refundable tax because you paid, but did you get it back? So such non-refundable taxes you can add. Refundable taxes you cannot add because common sense. Is it really an amount or you got it back? If you get it back, you can't add it to the cost of PP. That is not fixed. Okay, actually, if you have any rebates or trade discounts, sometimes when you buy in bulk quantities, suppose for one mobile the cost is 50,000. For one mobile purchase cost is 50,000. You told I buy 100. You told you buy 100. Now what is the first thing you ask? Hey, give me. It's not for 150,000 means for 100 it should not be 50. It should be lower. That discount we call it what's range. If at all that is the means reduce. When you do this, you will get the net purchase cost. By doing this, you will get the net purchase cost. That is the first category of cost for PP. So all this concept straight away gets tested. This is one of the popular question from which turns up has come. Meaning they don't ask the concept. They will give you some expenditures and then they will say, can you add this as cost or will you include, exclude or what you do? That's a popular question. So unless you know the concept, you will not be able to proceed. Further, so pay attention to the provisions because provisions are the main thing. If you know the provisions, any sort of questions they ask, somehow you'll be able to tackle. Okay, this is done. Next is what to DAC. DAC is a short form. DAC simply means directly attributable cost. For class purpose we used to call it as DAC. DAC simply means, suppose now, excuse me. Now if I buy a furniture, let's say I purchase a furniture from Bengaluru. My office is in Chennai. I purchase the furniture from Bengaluru. Why, sir? My choice. Don't ask why again. My example, my choice. Okay. So my office is in Chennai. Nungambakkam. Okay. But I purchase the furniture from Bengaluru and I paid 1 lakh for furniture. Okay. But right now furniture is where? Bengaluru. From Bengaluru, if it has to reach to Chennai, I have to pay transportation charges, right? So all that comes under that category. All that transportation charges, installation charges, assembly charges, testing charges, blah 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 blah. Everything will come under what's that? Because you can incur 101 charges. No? To get the asset from Bengaluru to Chennai, I can incur so much of expenditures. Standard will not go line by line item and say this expenditure you can add, this expenditure you should ignore. Like that they will not do it. But they will simply say, okay, they will simply tell one term. They will use one provision. That provision will tell whether you can add it or not. Okay, again, Different is going to cause some change. Okay, that terminology here, what's it? That directly attributable cost. What is the meaning of this? Simply this. Standard saying, till the time asset is management ready. What am I saying? Till the time that asset, the PP is management ready. Whatever cost you are incurring on that PP, add. Till the time that asset is what ready? Management ready. Whatever cost you have incurred on that particular PP, you can add. Related cost, not every time. Okay. Now, my office is where? Chennai. I will use the furniture where? Chennai. Right? Unless I pay transportation cost, can I use it? Can I use the furniture without incurring transportation cost? No. So is my transportation cost necessary to make furniture ready to use? Yes. That means it becomes what's it? That. Can you add it? Yes. Now furniture will be sent just like that, or will it come part by part? If it's a big furniture, it will take a lot of space. So usually the vendor will send it in part by part. Right? Then what I have to do? I have to assemble them. I have to make sure that all the parts are assembled and it becomes a furniture. For assembly, I have to pay some charges. Unless I assemble, can I use it? Will it become management ready? No. I mean assembly charges also is an example of what? This only earlier grade of your study, transportation charges or installation charges, etc. But AS using fancy terminology called what's it? They are all examples of that. Okay, Nashi? Comfortable, Nashi? Okay. No. Let me see how you understood. I have a receptionist salary. I have a receptionist salary. Can I add receptionist salary in my furniture example to furniture? Receptionist salary. Let's say furniture from Bengaluru to Chennai. For that furniture to come from Bengaluru to Chennai, it took about 1 month. It's a customized furniture. Let's say I told the vendor I need rosewood furniture. I don't want normal furniture. I need a sandalwood, please. Okay, sandalwood furniture. Yes. Okay. Furniture only. Not pushpad. I went to pushpad only. Okay. Right. Furniture to use only. Not to sell. That's my game. I'm a legal business. Okay. Just to use that. Okay. I said I need a sandalwood. I like the smell of sandalwood. I could make sandalwood furniture. Okay. But for that it take how many months? 1 month. So I said 1 month receptionist salary I will add to furniture. That 1 month receptionist salary linked to furniture or not linked. Whether receptionist comes to office or does not come to office, furniture will come. Yes or no? So is it a related cost or not a related cost? Only related cost is an example of that, not every cost. Okay, Nachi? Again, my screen. What is happening here? For you, will come. You don't want to see this. I'm getting a little bit whether the recording is happening or not. Okay. You probably have been always been giving recorded class. Hey, call someone for that. I think someone just called some person. Okay. You're went off on you. Yeah, give money was not good. Maybe Pakka this today 3:34 o'clock. It's getting time of 3:20. So we can decide. Because happy to 4 we ask someone. How bad are we? So we look at there are how many categories of cost? The net purchase. Big fee may not be considered my fee, but cost. What is this? Simple, sir. Same example I will give you. Reliance. Most of option of little net connections to do it. And ask 5 years. 2 lakhs. Only 10 lakhs repair cost will come. When no? After 5 years. Now what do you think building owner will say? Hey, my building is proper. You told you would put in 1 double. And then you are saying after 5 years you are putting me how much now? 10 lakhs repair cost will come. Yes or no? What do you think building owner will tell? Building owner will tell the Reliance people, you repair it. You repair it. Because my building was proper. It was only getting damaged due to your tower installation. Yes or no? And the building owner will say the Reliance, you repair that cost. Suppose Reliance says, no, I will not. What do you think building owner will say? What are they? I will not give you permission to install the telecom tower. Yes. That means for the Reliance telecom tower is a PP. For the Reliance telecom tower is a PP. Because it is asking for how many years? More than 1 year. Definition and RC is getting satisfied. To use this telecom tower, is this repair cost necessary or not necessary? For the management to use this telecom tower, repair cost is, that means it is what? DAC. It is what DAC cost is what you call it what? DAC. Yes or no? That means we can call it as DAC only. So why are we calling it as DSR? Why they create a separate provision for this is, so normally installation charges, transportation costs and all will come in the future or immediately. The installation charges, assembly charges and all will come immediately. This is coming immediately or after 5 years. And how much after 5 years? So 10 lakh after 5 years. What will you get? I mean now only, yes or no? This cost is coming in future. They have given a separate terminology called decommissioning and cycle installation cost. Is this a related cost? Is this a related cost? Yes. That means can we add a DSR cost to the cost of PP? Yes. But don't add. 10 lakh. Don't add a 10 lakh because 10 lakh is today's value or future value. Future. Find out its today's value. Find out its today's value, which we call it what's present. So I use some discount factors. Leave that aside. Let's say that comes to how much? 7. Future value how much? 10 lakh. Present value how much? 7 lakh. That means you'll only add how much to the cost of PP? Not 10 lakh. You'll only add how much? 7 lakh. But cost is 10 lakh. Balance 3 lakh is there. That goes off the P&L. As what? Interest charges. To the cost of PP, you only add how much today? That is something DSR. The difference between that full value and present value is the interest charges which goes off there. That much I think if you remember in my opinion at interval level is good. But clarity over all these three costs. Yes, more than extra. So till now we saw cost inclusions. What and all can be included? The next one is on exclusion. What are the costs? Refundable taxes. The organization. Become tax driven. Okay. Added is benefiting your whole business. Hence, any sort of marketing expenditure don't add it to the cost of PP, but rather transfer it to P&L. What about free issue? Free issue of books? That again, you get about PP. Books is an inventory, right? How will the inventory affect PP? Right? So that will not come in. Okay. So when the moment asset is ready to use, capitalization stops. Okay. So that will not come into picture. These are some cost exclusions which are called. More the next one now. Yes. Next one is subsequent recognition. So previously we discussed what? Initial recognition, which we know initially every PP should be recorded at cost. Okay. Now we are talking about subsequent recognition. Subsequent recognition means at year ending. At reporting period ending. Usually it's year ending. Some companies also follow quarterly financial statements. Okay. Anyway, for simplicity, we'll stick to this. So at every year ending, how should we account PP? Initially you record PP at cost. At every year ending, what we should do? That is the subsequent recognition provision. ASN gives you two options here. At the year ending, okay, you can follow one of the options. One we call it as cost model as in CM, another one is a revaluation model called R. Either we can follow cost model or we can follow a year ending. I think I'll transfer and move forward. Okay, for you it's coming. The moment it stops there, you can. Okay, so then I think okay. Cost model or revaluation model. Those are the two models which are acceptable for this one. Cost model, you know it. You've been doing it from the time you learn accounts. Tell me, sir. After you purchase PP, what do you do? Subsequently, you go on charging depreciation. You go on reducing depreciation and show the final value where in balance sheet. That is nothing but cost model. After purchasing PP, if you go on reducing depreciation and show the final value in balance sheet, we say companies following what model? Cost model. Actually, impairment also should be considered here, but leave that aside. We'll take it later. Okay. Next, if companies doesn't want this one, they can go for another model called revaluation. Revaluation model means simply to show the asset at its value. Let's say I purchase our Prem was sitting here. Luckily he came today. I thought I used his name too much and he'll come. So Prem purchased building for how much value? 25 lakh. See, you remember, I think I'll never forget that. He purchased for how much value? 25 lakh. Today that land value is how much? 25 lakh. If Prem shows that land in his books at 25 lakh, land we don't appreciate. If Prem shows that building or land in his books at 25 lakh, we say he's following what model? Cost model. Suppose Prem told market value is 25 crore. I want to show 25 crore in my balance sheet. Then we say he's following what model? Revaluation. Okay. So revaluation model means to simply show the asset at its fair value or market value. Company has a choice. Either they can go for CM or they can go for R. Okay. But there are some criteria or there are some things you need to keep in mind for revaluation. What is that? So selective application nature. Meaning selective application you cannot do. Meaning, so if you want to follow revaluation model, entire class of PP should be revalued. Suppose I have 3 machineries. I have how many machineries? 3 machineries. One I'm using for morning shift 2. I have factory. Morning shift I will use machinery number 1. Afternoon shift machinery number 2. Late night shift or night shift machinery number 3. All identical. Same. Okay. They are used for different times. 8 hours I'm using. So that my factory runs 24 hours a day. Okay. Now for machinery 1, okay, I want to follow cost model. For machinery 2, I want to follow revaluation model. For 3 also, let's say I want to follow revaluation model. Acceptable or not acceptable? Because these 3 belongs to different class or same class. Same class means they're identical. If the assets are identical, then you can't do partiality. One will cost to one revaluation not acceptable. Either for all the 3 you have to follow cost model, for all the 3 or you have to follow revaluation. One cost to one RMO not acceptable. Within the same class, partiality not acceptable. That's what we mean by you have to do the revaluation on entire class of people. Okay, so suppose I have a machinery and I have a furniture. I have one machinery and I have a furniture. For machinery I want to do cost model. For furniture I want to do revaluation model. Is this not acceptable or acceptable? This is acceptable, right? So machinery and furniture are identical or separate? If it is separate, class means partiality alone. Meaning for one you can follow something else, other one you can follow something different altogether. This is fine. Within the same class, partiality is not done. That's what we mean by this. Class means again what's it? A group of assets which are similar, which has the same cash flow, same usage, similar, etc. That becomes your one class. Okay. So how often should we do the revaluation model? Because fair value will be same. If today market value is 25 crore, tomorrow it will be same. Tomorrow it will be more or it will be less. That means market value changes every day, every week, every month possible. I mean every month we go on accounting. No. So there must be some time frame or a window. What standard says is if you have a volatile PP, if value of that PP fluctuates too much, maybe in case of land or building, then you have to do revaluation at least yearly once. You have to find out the revaluation at least once. If the asset value is not changing so much, maybe like furniture or machinery, then you can do revaluation once every 3 to 5 years. That is what we do. If the volatile question is specified whether it is volatile or not, you don't have to. Okay. Yeah. Still there, no? Okay. So volatile PP at least once you have to do annually the revaluation. Or other non-volatile you can go for 3 to 5 years. Now, if you want to go for revaluation, how accounting will play, just summarize it to the chart. We have done some questions also on this, but in regular class. But now, I think this example should be good enough for us to learn. Okay. Suppose company wants to do revaluation. Okay. Let's take an example of a land. It's easy to explain the land. Okay. Now, people, first time I did a revaluation. First time I purchased the land in first year, and first year ending I want to follow what model? Revaluation model. To find the revaluation model, I need one component. What is it? Market value. So I found out the market value. Okay. Let us say I purchased the land at an original cost of 50 lakh. When I purchased the land, I paid how much, sir? 50 lakh. But at year ending, the market value has become 55 lakh. At the year ending, it has become 55 lakh. Sad face or happy face? Happy face. Meaning it's a case of what? Gain. So first time I did a revaluation, I got how much gain? No, 5. What we have to do? Standard simply says first time you do revaluation, if you get a gain, right? This is a realized gain or unrealized gain. Realized gain means you have got this gain. Have you got it or only bookish gain? See, you will get a gain only when you sell the land. Have you sold this land or not yet? Not yet. Because this is only what just market price value increase. I have not sold this land, right? So this is a bookish gain. So AS10 says you transfer this gain not to P&L. You don't transfer this gain to P&L. Put it in one reserve. Put it in one reserve. That is called what's a revaluation reserve. Okay. So this 5 lakh gain you park it in one reserve. But revaluation reserve. Tell the entry first. Let's see. Tell the entry first. Currently my land is showing my books at 50 lakh. But I want to follow what model? Revaluation model. Revaluation model means to show the asset at carrying amount or market value. Revaluation model means you want to show the asset at its market value. That means from 50 lakh I have to bring the asset to 50. Fine. Asset has what balance? Debit balance. Now you have to increase that asset balance or reduce? Increase. Something which has debit balance. How do you increase that? Debit against what's the increase? Land account or PP account debit how much? Fine. And you transfer this gain to P&L or specific reserve. Since it's unrealized again, standard is recommending us to put it in one reserve called revaluation. This is the entry cost. Any problem? No. Okay. What are you okay? Carlito. Yeah. Let's take ulta example. Let's take the ulta example. This was the case of what, sir? Gain. Next it could also be a case of loss. First time I did a revaluation, I could get a loss. When did I get loss? When market value is increased or market value is reduced. Let's say market value is reduced by 7 lakh. So it will be a case of first time I did a revaluation, I got what's the loss. How much loss? 7. In that case, what you do? You use no. In that case, standard says market in P. Loss to transfer it out to P. I know a little partially, but that's it. Because Indians, accounting standard is big one, still on conservatism ones. What does conservatism prudence concept say? Loss you transfer. Gain you wait to. Gain you wait till the time you get to the gain. Loss you can transfer in loss. That's what conservatism says, right? So even this is also a little extension of that. So if you get a loss first time, you transfer the loss where's the P. Tell me the entry for this. You got the loss means asset value has to be increased or reduced. Asset has debit balance. How do you reduce it? Credit PP. What do you debit? P. So the entry will be P and account debit to PP. This is the entry. Either this will come or. Okay, maybe take one step further. So first year, I take the scenario. First time we did revaluation and we got a gain. How much gain? Fine. First time we did revaluation and got a gain of how much? Fine. This is the first year. So mine is a volatile PP. My asset is a volatile PP. Volatile PP means I should revalue only once or every year. At least once I have to do it every year. I mean, second year also I should revalue. Second year again I did revaluation, but this time I got to ask to not do. I got a loss. First year when I did revaluation, I got a gain of how much? Fine. Second year I am getting a loss of 8. What? Getting scenario. This is continuation from year to year. We are jumping. First time gain, second time loss. Okay. Now loss means where we value transfer. P. So do you have any balance in RR? How much? Right. So don't transfer entire 8 lakh loss to P because you have a balance in R. So out of 8 lakh, how much loss you adjust against RR? Right. How much is still remaining? 3. The 3 lakh only you transfer there. That's the option. So second time when you do a loss, that loss don't directly transfer to SP. First check whether you have balance in RR and adjust that balance with what? RR first. Still if there is any loss remaining, means transfer it to P. That's much. Okay, G. Okay, G. Tell me the entry for this G. Loss is 8 lakh. So PP you have to increase or reduce? By how much? 8 lakh. So you credit PP by how much? 8 lakh. Okay, G. You debit P into the 8 lakh or first RR? RR will debit by how much? 5 lakh. Why 5 lakh? Because balance available is 5 lakh. So here RR credit, here RR debit. You got smash. Nullified. Still losses there are. Yes. How much loss still remaining? 3 lakh. You transfer there. P. That's also fine. So this is the continuation from year to year. Can we move to the next scenario? What do you think will be the next scenario? First time I did revaluation, I got a loss. Second time I did revaluation, I got a gain. Okay, that's scenario. From year to year, first time I got how much loss? First time when you get a loss, you don't have RR. First time when you do evaluation, you get a loss. There's no RR. So where has this loss gone to? Okay. Next time you got how much gain? 9. Gain means you park it in one reserve. What? But don't transfer entire 9 lakh to RR now. Why? Initially when you got a loss, you book how much in P&L? Reverse. How much extent? First adjust how much to P&L. Balance 2 lakh only. Gain you transfer it to reserve. So whatever you've done before, first undo that. Do the ulta of that, and then proceed with it. Okay. Tell me the entry for this. Gain of 9 lakh. Gain means PP you have to reduce or increase. How much? 9 lakh. So what is the entry? PP account how much? 9 lakh. To RR 9 lakh. No. How much loss you booked in P&L? So that means you credit P&L by how much? 7. Balance 2 lakh only to. That's fine. Is this good enough? Okay. For depreciation, let's say we do slightly differently. I think I'll not go into that for the time. You'll learn about that finally. There's some extra material left to do. 2 extra methods will leave. Not important. Okay, next. Moving on to the next one. No? Any doubts so far? All okay so far? That's still good so far on the screen there. I don't have to show you so far. No, but mine did come on. It pulled all the way. So I don't know what it is. I'll shake it. No, it's not coming. Okay. Next. Concept is PP acquired on a deferred credit. PP acquired on deferred credit. What is this concept? Very simple. Sir, when I buy, not okay. Let's maybe. I'm talking yesterday. Oh no. Let's say sir, I purchase a furniture. Now, normally business don't do a transaction not on a cash basis, but on a credit basis. When you do business to business transactions, usually you do a credit basis. Let's say furniture, usual credit is 1 month. Usual credit is how much? 1 month. Meaning I will buy it today and make the payment within 1 month. I told the vendor I need 2 years credit. I need how many years credit? 2 years credit. Normal credit is how much? 1 month. But I'm asking how many years credit? 2 months. This concept we call as PP acquired on a deferred credit, meaning you are taking the normal credit or more than normal. More than normal. In that case, what we have to do? That's all this concept. Okay. I'll maybe take you through this example. So let's say I purchase the furniture for house value 12 lakhs. How much credit I'm asking? 2 years credit. Okay. So if I purchase the same furniture under normal credit, how much normal credit? 1 month. I have to pay just how much? 10 lakh. For 1 month credit, my purchase price is 10 lakh. Since I'm delaying the payment by 2 years, the other vendor is saying give me not 10 lakh but give me 12 lakh. Okay. Both points are fine with you. Now the question will arise: I should record PP in my books today at 10 lakhs or 12 lakhs. Got the concept? I should record the PP in my books today at 10 lakhs or 12 lakhs. Okay. Overall concept is what AS and provision says is whenever you do any transaction on a deferred credit basis, meaning not under normal credit basis, you'll have to record the PP at cash price equivalent or CPE. At what price? Cash price equivalent. The provision is the difference between the total transaction price minus cash price equivalent is your time value of money interest charges which goes off the payment. So nothing understood. Very simple. Recorded under normal credit value. Recorded under normal credit value. What is normal credit value? So show the PP at what value? This only called as cash selling price, or you can also call it as cash price equivalent. Both are fine. Okay. So you record the PP today at what value? 10. But are you paying 10 lakh or are you paying 1 lakh? Well, how much extra are you paying? Now honestly, cut your heart and tell. The 2 lakh what you're paying, is it for PPE or is it for the delay? It's for the delay. Okay, so when you take a loan and when you repay after 2 years, your bank will get interest from you. Interest you'll capitalize or goes to PN. Okay, that's what AS and HSC. So the difference between these two, which is what 2 lakh, is the interest charges and it should go where? PN. Do not capitalize that but transfer it off to PN. That's how we need to be done for extra CFN. Not quite. Again, I'm saying overall got it off. So what is the provision once again? If you, this is a normal credit or deferred credit. In deferred credit transaction, record PP at normal credit value. The difference between the transaction price, which is 12 lakh, and the normal credit value, which is 10 lakh. In this example, the difference is interest charges which you transfer to PN. That's all I've written with. Move on to the next. Okay, next. Well, what more than the concept clear. The standard concept clear. And based on that, we'll see how many questions we can take. So today also you'll break at 11:30 or something. This one, one more today, you can have that. You can bring back that smile. Okay. I'm saying tell me the time now. This one and next standard 9:30 I will go. 9:30, 9:30, 9:40 max. And then you like 10:30. We got to know why. He said 9:30 means 10:30. Not like that. Don't be like that. Okay. Next one is still okay. Okay, fine. I don't know much of space, man. I'm not PNC. Some cable issues. Hopefully you're recording. She told you don't do that. I will do that creativity. Now I'm scared to wear. She's like, I told you don't do it. What she gives me someone dead. Okay, leave that. I hope it's recording. Next concept is PP acquired on the exchange barter system. Barter system. We exchange lunch and buzz and all. Like that business also is doing one exchange. They are giving one PP and purchasing another PP. That we call as what's exchange. Okay. For that exchange, what we have to do? Fine. I tell you the problem, and then we take up one example maybe. Whenever first of all, what is exchange? Exchange means what? One PP coming in, another PP going out. It need not be what is going out, need not be necessarily PP. It could be intangible asset also. But for simplicity, we keep it as what? One PP coming in, another PP going out. That's now we call it as exchange. Okay. Now what ASN says is whenever you do an exchange transaction like this, as a thumb rule, whichever PP is coming in should be recorded at fair value. Whichever PP is coming in should be recorded at fair value. Now fair value need not be used. You don't have to use fair value only and only under two circumstances. Fair value should not be used or need not be used under two circumstances. One, when the transaction lacks commercial substance. Second one, fair value is not found outable, is not determinable. Okay. So once again, I tell you the provision. You don't have to remember it, but they will give you a numericals like this. If you know the provision, then you can handle it better than I feel. So whenever you do exchange transaction, whichever PP is coming in will be recorded at what value? Fair value. Not transaction value. Not carrying amount. But what value? Fair value. But under two circumstances, fair value you need not use. What are those two circumstances? One, when the transaction something called lacks something called commercial substance. And second scenario, you cannot find out the fair. If one of these scenarios comes out, then fair value will not be used. Otherwise, you have to compulsorily use what value? Fair value. Okay. So this one we understood. So fair value not found out. That's okay. Manageable. I think we made peace with that. Correct? No. What is this lacking of commercial? Blah blah blah. Transaction lacks commercial substance simply means cash flow will not change. Cash flow will, in simple terms, whatever, let's not go so much into detail. Okay. Transaction lacking commercial substance simply means what? Cash flow will not change. Because of this exchange, neither you will get more cash flow nor you will get less cash flow. How much ever you were getting before the exchange, same cash flow you will get after exchange goes. So if your cash flow does not change, then we call it as what's a transaction lacking commercial substance, or transaction does not have commercial substance. Like that. Go in the got it. Balcony also okay. That all good. Let's take an example just to give you a little more clarity. Sir, I have a car. I gave away car and I purchased what? Machine. I gave away car and what did I purchase? Plant machine. So whenever exchange transaction happens, it's always good to identify what is coming in, what is going out. Write it on a side of paper, man. I mean, your answer sheet. Okay, at the end of it, just simply write. So make one small box and write which asset is coming in, which asset is going out. Here, what is going out? What is coming in? Plant machine. And write two details for it. Carrying amount, fair. It will be given to you in the question. Let's say the carrying amount of the car is how much? All these are assumed numbers for the sake of explanation. Fair value how much? 11. And fair value of machinery is how much? 12. Okay. This data will be provided to you in the question. Just have it in some corner. So it'll help you to pass the entries first. Okay, this is now go back to the provision. Is this an exchange? Yes. Right. What am I exchanging? Car I am giving away and I am purchasing plant machinery. So one PP is coming in, which is what? Machinery. Another PP is going out, which is car. Now whenever exchange transaction happens, go back to your provision. As a thumb rule, what we have to use? Fair. As a thumb rule, we have to use fair. Okay, Raji. Second, fair value should not be used. Under one of the two circumstances. One what? Fair value is not determinable. Here you cannot find out fair value. Fair value is given. So that scenario is there or it is ruled out. It is not applicable because you are able to find out fair value. Second condition says you should not be able to find fair value. That is getting applied here or not? Here you are finding fair value. Yes, so that's what is another one? Transaction lacking commercial substance. Transaction lacking commercial substance. What did I say in simple terms? Lacking commercial substance means what? Because of this transaction, cash flow should not change. How much ever benefit you are getting from car, same benefit you should get from that machine. So using car, using machinery same. Using car, using machinery same, completely different. Completely different. I mean, this transaction lacks commercial substance or has commercial substance. In this transaction, transaction is not lacking commercial substance, but rather it is having commercial substance. I mean, we should ignore fair value or consider only fair value. Because transaction is what it is. Transaction is having commercial substance. I'll give you another example for lacking also. But okay. So now we have established one thing is what? We have to compulsorily use what? Fair value. Now second question is which fair value? Because this is fair value, 11. This is fair value, 12. Which one should we use? We understand because we have one set of fair value, standard says, okay, you can use whichever assets of fair value you can find out more clearly. Because market price is subjective now, right? So what standard says, you can use whichever assets of fair value which you can find out more appropriately or clearly. But for example, you always take, this is just for example, you always take fair value of the asset given up. First priority you always take what? Fair value of the asset given up. What did we give up? Give up means asset going out. What asset is going out? That means first priority will always be given to the fair value of car in this example. If this is missing, then you take what? Land and machinery. Other perfect. Did you understand this? In fact, I used to tell this as easy remembrance. You know your house information better or your neighbors? You know your house information better or your neighbor? That depends on the neighbors. If neighbors pretty, then we will like better. Not that way. We're not going to romantic things over here. Yes. So obviously we will know our asset information better. Okay, so which is our asset here? We are using car right now, so we will know the fair value of the car better. Hence, for exams, first priority is always what? Fair value of the asset given. Okay, but standard gives you the liberty to use whichever. But exam uses this one. Okay, now entry. For a moment, forget about the amount. First pass the debit and credit. You know we are going to do it. Debit what comes in, credit what goes out. Which is coming in? Land and machinery. Debit. Forget the amount. First complete the entry. Debit what comes in. What's coming in? Machinery. What is going out? So credit card. This is out here now. Now the value. Car is going out means can I show it in my books or cancel from my book? Cancel. Yes sir. Sir, currently my car is shown in my books at what value? 10. If it is shown at 10 lakh, I have to cancel also for 10. I'm sorry, you credited what value? 10. Why? Because it is carrying amount. I have to cancel. Yes or no? So this is figured out. None of people. Now what did I tell? Whichever asset is coming in, should be recorded at fair. Whichever. Okay, same. Since fair value should come up, carrying amount. Cancel it. Are you using fair value here or not using fair value? If you're not using the same how long you will charge depreciation over the useful life. If you're planning to use asset for 5 years, you depreciate for. If you're planning to use asset for 75 years, depreciate over 75. Some assets like nuclear power plant, hydro projects, last asset can last real long hauls. Okay, so basically depreciation should be charged till the useful life. When will you start? From the day you from the day asset is ready to use or put to use. I'll tell the question once again. You'll start depreciation from the day asset is ready to use or put to use. Let's say my furniture, say Bengaluru to Chennai, standard furniture. You remember now? Okay, it came today. It came today. I said next month first day Vastu is very good. I'm a big believer in Vastu. Example. So today my furniture came, standard furniture came to my factory, but I want to open it only when next month because Vastu is good. Okay, that means when is the asset ready to use? Today. But when did I put to use? Next month. So when will you charge depreciation? From today or from next month? You don't bring your income tax fund. Income tax act says you have to charge depreciation from the day it is put to use. For accounts are concerned, it's always ready to use. I told you the logic of that. I'm not going to that detail here. Okay. So you will always start the depreciation from the day PP is ready to use. Put to use is absolutely relevant. Okay, I give you my full example if you remember. Why it is put to use? I'll not go into that now. Not much relevant. Okay, sir, everyone good? Next. So remember this. You will charge depreciation on the asset only if two conditions hold true. You check two parameters. You check two parameters or two conditions. Only if they are satisfied, you will charge depreciation. One, DA should be positive. Useful life should be limited. If these two are satisfied, you will charge depreciation. Otherwise, no depreciation. What is that? DA should be positive. Useful life should be limited. DA means depreciable amount. DA simply means depreciable amount. It's very simple. Don't get figured. Straight line method of formula. Straight line method of depreciation. Only numerator formula. Carrying amount minus residual. You also divide by useful life. What is the denominator? Numerator is what? Carrying amount minus residual. From carrying amount if you reduce residual value. From carrying amount if you reduce residual value. That result figure only called as depreciation. So DA is nothing but carrying amount minus residual value. This number should be compulsorily what? Positive. Only if this is positive, definitely. Otherwise, no. Maybe I'll have one question. I'll take it to that words. Now the only go from topic. Carrying amount is 10 lakh. I purchased a building. I got a good deal. I purchased it for how much? 10 lakh. I'm planning to use it for 5 years. I feel after 5 years its value is going to be 25 lakh. I feel the building value after 5 years is going to be 25 lakh because it's a sophisticated building. Like every area will have some niche buildings. Like in Bangalore, it is UBCity buildings. You know, Malya has constructed a beautiful structure that we call as UBCity. Okay, UBCity is quite costly in Bengaluru, especially the floor and I think in Bombay it's not in the point. I don't know in Chennai. Chennai building is constructed as full life. Apartment. Okay, don't get issues. Okay, so I purchased one building in UBCity. For how much value? 10 lakh. I want to use it for how many years? Yes, 5. Building I can use it for 20 years also, but I want to use it only for how many years? 5 years. Okay. After 5 years, I will sell. I'm planning to sell. After 5 years, I feel its value is going to be how much? 25. What does residual value mean? What does residual value mean? Don't say scrap value. When you say scrap value, you'll not get the hard to write the big value. Residual value simply means when you sell the asset, how much money you will get. Residual value simply means when you sell the asset, how much money you will get. That money can be really big, and money can be really small. Usually, residual values are very small, but some residual value can be really big. Here, now check how much am I planning to sell this building for after 5 years? 25. Means 25 becomes what? Residual value. How much did I buy the asset for? 10 lakh. That means what is this? If I do the like DA, how much is DA here? Minus 15 lakh. Means depreciate. Don't touch. Because is the asset really depreciating or more appreciating? I bought it for 10 and I'm planning I feel I can sell it for 20. Means is it really decreasing in value or increasing in value? So do not depreciate. That's what standard says. If the depreciable amount is, if you want to depreciate the asset, DA should be compulsory what? Positive. In this example, positive or negative. So you charge depreciation or no depreciation. No depreciation. That's one. Once more knowledge. Once more knowledge. Okay, next. Second criteria is useful life should be limited. So I'm planning to use this building for how many years? I mean I will depreciate for 5. Land is born up, right? Which method I should depreciate? Which method I should select for depreciating the PP? Standard says whichever method you want. Yes, and says whichever method you want to depreciate, you depreciate. Whichever method you select should reflect the pattern of economic benefits. The method that you have chosen should reflect something. What it should reflect? Pattern of economic benefits. It's very simple, man. You depreciate the asset based on benefit ratio. In the ratio of benefit, you depreciate the asset. Suppose I bought a machinery to produce the goods. I feel I will produce the goods for 5 years and I will produce 1 lakh units every year. Okay, from that machinery, how many units will I produce? 1 lakh. How many years? 5 years. Is that production changing or same every year? Same every year, which is how much? 1 lakh. Which method of depreciation gives you the same depreciation? Each method of on PP or others also. Right? Like if there is any change in these three parameters, depreciation also will change. And any change in them is accounted as a change in accounting estimate. It's not accounting policy change, it is an estimate. Okay? Because useful life is a pakka number or estimated number. Residual value is a pakka number or estimated number. So hence any change in these parameters is considered not as a change in accounting policy, but as what? Change in accounting estimate. Estimate change is always accounted prospectively. Meaning from that day onwards. Suppose residual value changed in third year. Residual value changed in third year. Depreciation also will change in third year. First year, second year, what you have done. Should I be bothered or not bothered? That's what prospective change means. The third year may have estimate change. From third year onwards, depreciation also will change. First year, second year, what you have done. You don't have to worry about that. What is one is one. That. One next up. Yeah. So when you stop depreciation? When you stop depreciation? When asset is sold. When FEB stops, what is FEB? Usual economic benefit. So in order to show PP, there should be FEB. If FEB stops, asset also will continue, asset also will stop. So retirement of PP. So retirement means what? permanent break? Yes, no. So sometimes what will happen is physically asset will be present. Physically asset will be present, but we are not using it. Let us show in our Bangalore whatever. In our, just again, we are not using it. Meaning carrying amount from or is it okay with just like that? Okay, accounting standard 10 talks about property, plant, and equipment. So few things are excluded from PP. One is biological assets, exploration assets. Biological assets means living plants and animals. For this, there's an exception called bearer plant. Meaning for bearer plant, ASN is applicable. For other plants and animals, not applicable. So if you want to call a component as PP, three definition criteria should be satisfied. Tangible asset, held for use. The usage should be either to produce goods, render service, administrative purpose, or rental purpose. The usage should be for more than 1 year. Okay, these are three conditions. But along with this three definitions, there are two definition criteria, which is FEB and cost mention. Future economic benefit and cost mention. All the five criteria satisfied means PP will come in balance sheet. Otherwise, our expenditure goes off to P&L. Okay, next, biological assets, living plants and animals. So if you want to call a component as a bearer plant, one from that plant you should get agri produce. A produce you should get it for more than 1 year. The tree you should sell regularly or only as scrap. Only as scrap. All the three satisfied, it is a bearer plant. If it is a bearer plant, ASN applies. Okay, next, spare parts and standby equipment. What do you do? All criteria satisfied, PP. Otherwise, inventory. If you're replacing any parts or image inspection, new part of cost you will add. Old part of carrying on will minus. Initially, all PPs are recorded at cost. Cost for this are three categories: purchase cost, or rather net purchase cost. That DS. How you get net purchase cost? Take purchase cost, non-refundable taxes and import duty you add. Rebates and trade discounts you minus. That means what? Directly attributable cost. They are those costs incurred to make the asset management ready. Okay, that examples are installation, assembly, delivery, blah blah blah. DSR cost can be added? Yes, at full value or present value. Present value DSR cost you add. Okay, some costs are exclusions. One, refundable taxes, any administrative overheads, general selling and distribution overheads, relocation costs, reorganization costs, any sort of promotion expenditure. Subsequently, how can you record PP? One of the two. Cost model or second time you do revaluation. If you get a gain goes to revaluation. First time you do revaluation and get a loss goes to P&L. First time gain, then loss. Or you loss you transfer to P&L? No. First just loss with RR. Balance loss you transfer to P&L. First time loss, then gain. First time loss, then gain. Second time you get a gain, entire gain to RR? No. First whatever loss you booked earlier, reverse it. Balance gain you transfer to RR. If you purchase PP on a deferred credit basis, deferred means normal credit or extension. When you do extension, what do you have to record PP at normal credit value. That only called as cash selling price or cash price equal. Transaction price or cash price difference is interest charges transferred to P&L. Next, if you do exchange transaction, whenever you do exchange, as a thumb rule you have to use fair value. Fair value need not use under two circumstances. One, transaction lacking commercial substance. Second one, fair value not determined. Okay. Alright, simple way to pass the journal entry is first finish the entry. Asset coming in you debit. Asset going out you credit. Asset going out should be cancelled. Cancellation will always happen at carrying value. The asset coming in will be recorded at fair value. Which fair value? For example, the priority is always fair value of the asset given up. Difference you transfer to P&L, it could be a gain or it could be a case of loss. Depreciation. If you want to charge depreciation to credit, useful life unlimited. DA should be positive. Depreciation starts from asset is ready to use. Okay. Which method of depreciation? Any method which reflects pattern of economic benefit. Basically, benefit ratio you use. Okay. Can depreciation method be changed? Yeah. Can useful life be undergo revision? Yes. Can the residual value estimate change? Yes. Any change in these three are changes in accounting estimate. Always done prospectively. Can you depreciate based on revenue? In sales ratio? Not acceptable. Any asset which is retired? What do you do? It will measure the carrying amount or net realizable value, which is lower the difference to P&L. Okay. Okay. Let's take one. Again, I have time for one question. I don't have time for that, so yeah. Fine. We will do this. I'll use this apart. No. I see now I'm taking your apart into picture and taking the number of questions. Okay. Question number 18. I think this is a very question. And our last question as well. Quickly, I'll read. Srushti Limited company. They're contracted with a supplier to buy machinery, which will be installed in how many months' time? 3 months. So machinery is immediately ready for after 3 months. It will become ready to use after 3 months. Special foundations were required for the machinery, which were prepared within the supply. Blah, 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 cost of site preparation is 141,870. So site preparation also is an example of that. Site preparation means let's say the land is like this. So Humpty Dumpty. Your land is not level. It's not straight. It is a little bit like this. Can I install the machinery on the land? What's up? Site preparation machinery. For me to can I add this? Can I add site preparation cost? Cost of PT? Yes. Waiting. Whatever you say, waiting. The question is this one. What they will give you majority many costs and say can you add or subtract or exclude? Okay. These activities were supervised by a technician during the entire period who is employed for the purpose of 45,000 per month. So someone supervising this work because asset is not ready. It will take how many months? 3 months. So somebody supervising this work for how many months? 3 months. Nobody will supervise the free of cost. How much are we paying them? Okay. So that's for 1 month. How many months asset is taking? Multiply 45 is how much? 135 is it? 1,35,000 can be added? Yes. Because it is also an example of that. You don't have to call it as a DAC to DSR and add. Simply you can add. For our clarity, we categorize them as DAC to DSR. Example you don't have to mention. Okay. The technician service was given by department B to department A, who billed the service at 49,500 per month. So this technician, no, we did not hire from outside. We hired from other department. Now here, you maybe have CA department, CS like this. So one department is giving service to another department. But they are not giving service at 45, they are giving service at 49,500. Means how much profit they are including? The difference between these two is what? 4,000? Sorry, so it's an internal profit. Profit not getting included in the cost of PTR. Cost can be included. Profit no. So means will we take 45 per month or 49,500 per month? 45,000 per month. And for 3 months it's 45,000 into 3, which is 130. So if there is an interdepartmental work going on and any profit is included, eliminate the profit. That's a takeaway. Machinery was purchased for 1 lakh 1 crore some amount. Purchase cost can be added. Yes, but hang on. This amount includes IGST, includes GST what rate? 12%. And tax, this is a tax. What does ASN say? Refundable taxes exclude. Non-refundable taxes you can include. That's right. Now we have to know whether the input credit for this tax is available or not available. Check what they're saying. This is the purchase price. This is the purchase price, and it includes how much IGST? 12%. For which input credit is available. So input credit is available means it is what? A non-refundable tax or refundable tax. It is a refundable tax. Right? Because on one hand you are paying, on the other hand you are recovering. Pay attention here. So that line take care. Yeah. So this is what? This is what? Refundable taxes. Can we add this or exclude this? One second, guys. I'll have a question. Thanks. Yeah. Yeah. What was I saying? Basically 12 rupees, right? 12% GST. So 100 example, if 100, that we put this example, see what GST value is 1 crore 58 lakh 34. If this is 112 means that is 100. If this is 1 crore 58 lakh, proration. Your rent is the amount number. You want to cross check with your first. What are you getting? This quotation charges back. Can you add? Yes. Add it up. There is a lot of overlap between ASN and AS. 26 many provisions are similar. Okay. Overlap between ASN and AS. 26 many provisions are similar. Next we are revising. If I like 140 minutes. That's all the intention of this question. Okay. Thank you for your time. More patience. Hello, people. Welcome back after the break. So, hello, people. Let's start AS 18 ka revision. AS 18 is close to both of us because it is related party. You and I are related, no. Related, not blood related, but our Rishta is much more deeper. Yes. So, yeah. So, AS 18 talks about what's it? Related party disclosure. Again, it is not an accounting, it's not a recognition standard, it is only a disclosure. This standard impact will only be felt in notes to accounts. You just have to disclose something. Just like AS 17, you have to give some information in notes to accounts as per AS 18. Nothing to be done numerical. Just disclosure. Now, why this standard? Why was this introduced? So let us say, we charge 30,000 as CA coaching fees, both the groups. 30,000 is our coaching fees for both the, don't laugh, we charge very less only. So, coaching fees how much on CA interval? 30,000 both the groups. Okay. No. One of my cousin approached me. Oh, he is giving 41,000. Okay. 60,000. Go on increasing coming 4 lakh. I say you know how much they're charging. I won't go into operations part of it. But anyways, I've just already written 30, so let's freeze it at 30. So we are charging how much for both the groups? 30. Example, don't take it to heart. You have 85 crores building, why are you doing? Okay, so now, once again, we are charging 30,000 for both the groups. That is finalized. Okay, so now my cousin came to me and said, I'm not coaching. I want the coaching. I said, you are cousin. For you only 15,000. For you only 15,000. For others, how much? 30. For you only 50. For you 1 lakh. You're asking too much for 1 lakh. Okay, so come back to the topic. Others, how much am I charging? 30. But for my cousin, it is only 15. Why reduction? Because this cousin is my relative is playing that spoil sport. That is causing a problem here. Yes, no. Because of that relationship, I'm charging less fees to that person. Yes, no. Now think from Ariu Prokash shareholders viewpoint. From my point, it is okay. He's my cousin, so we give a discount. But think from Ariu Prokash shareholders perspective, is it fair for them? Why? So if you start giving discounts like this, Ariu Prokash profit will be low, and they will not get much of their dividend. Yes or no? Correct. As a shareholder, don't you think they would want to be aware of such transactions? If you're a shareholder in Ariu Pro, don't you want to know how many such transactions we have done? That is what AS 18 is trying to do. If you have done any related party transaction, it might not have happened at fair price. It may or it may not have happened at fair price. Hence, you need to what? Disclose. Okay? No, sure. What to disclose? That's the background. That of surgery. Not a surgery. Now, as far as AS 18 is concerned, how you become a related party? How you become a related party? That's all we need to do. The scope of the standard is very simple. Who is a related party? Who is not a related party? What related party disclosures you need to give? Only things. Who is RP? Who is not RP? RP is related party. What disclosures you need to give? That's all. It's simple. One page, change to chart book. Questions are good. Yeah, but yeah, overall concept is only this much. Now, one by one we will go. Sir, two individuals can become a related party. What did I say? I'm not talking about company. I'm talking about two individuals. Two individuals can become a related party provided one individual is able to control or exercise significant influence over the party. If one party can control or significant influence over other party, then those two parties will become what? Related parties. So how do you get control? Already knows. How do you get control? If one party has more than 50% voting power, then we say you get control. How do you get significant influence? Same. If the voting power is 20% or more, with 50% or more you get control. With 20% or more you get SI as a significant influence. If control or significant influence, if it exists, then two parties will become what's a related party. Stop there. Take this example. Let's say Mr. X. Let's say Mr. X has 80% shares in Y Limited. Mr. X has 80% shares in Y Limited. Are these two related parties? Are these two related parties? Yes. How? With 80%, what do you get? Control. If control is there, means automatically these two will become what? Related. Agreed? Take example number 2. Mr. X has 30% shares in Y Limited. With 30%, you get control only SI. SI means what? Significant influence. If you have significant influence, do you become a related party? Yes. That means these two will become what? Related party. Yes. How? Correct. Okay. This is one. Take this example. Mr. X has 30% in Y Limited. Mr. X has 30% in Y Limited. You already laughing. Mr. XO and Y Limited are they related party? Yes. Why? Mr. X has a significant influence over Y Limited. No, Mr. XO has Wi-Fi. Mr. XO. Okay. Now the question is, are these two related parties? Understood the question? Are these two related parties? Yes. Now that is not the question. The question is, are these two related parties? Yes. Yes. How? Sir, in the office, X will control Y Limited. In the business scenario, X will control Y Limited. But when he goes home, he immediately like, honey, you know what happened today? Yes, sir. What scenario? Who will control now? Y will control X. Don't go this one. Okay, just an example. Take it right spell. Yes. So, sir, if these two are related party means not only that individual, the relatives of that individuals and the company also will become individual का relative and the company will also become related party. That's ASAD. Okay, now, so who's relative? So, Matashi, Pitashi, mother, father, brother, sister, wife, children. Okay, sir. These are considered as what? Relatives. So, girlfriend, boyfriend. ASAD is like Shantam, Papam, Shantam. Only legally allowed. Girlfriend, boyfriend, your living partner, and all not considered. But when you come to CA final, no. CA final is legally allowed. Girlfriend, boyfriend, your living partner, and all not considered. ASAD is like Shantam, Papam, Shantam. Only legally allowed. Girlfriend, boyfriend, your living partner, and all not considered. But when you come to CA final, no. CA final, Tashi. Become related party. That's ASAD. Okay, now, so who's relative? So, Matashi, Pitashi, mother, father, brother, sister, wife, children. Okay, sir. These are considered as what? Relatives. So, girlfriend, boyfriend, AS18 is like Shantam, Papam, Shantam. Only legally allowed. Girlfriend, boyfriend, your living partner, and all not considered. But when you come to CA final, no. CA final is IFRS. International standards, they say even domestic partners, your living partner, your girlfriend, children, boyfriend, children from the previous marriage, all are related parties. Not here. Where you write that answer? CA final. You are in which stage of CA inter. So you think only from the Indian context. From the Indian context, girlfriend, boyfriend, and all are not. They are not related parties. Huh? CA final, yes. Here, no. Okay, now as far as CA inter is concerned, it's only Matashi, Pitashi, siblings G, husband G, wife G, children G. Nothing beyond that. Those are relatives for AS18 respect. Comfortable, sir. So what is the takeaway of this example? What is the takeaway of this example? Can an individual and company be related party? Yes, provided that individual either has a control or significant influence. Only that individual and company will become related party, or even that individual are related. That individual are related and the company also will become related party. That's overall fund of this example. Easy. Okay. Next provision. Company and KMPs are related party. Company and KMPs are related party. KMP means what? What's the form of KMP? Key managerial persons. What does KMPs do? They take the major decisions. Definition wise, if you look at KMPs are those individuals who have the authority and responsibility of PDC, planning, controlling, directing the activities of enterprise. So basically, the decision makers are referred to as what? KMPs. So how will we know whether they are decision makers or not? Simple. For examination perspective, every director is a KMP. If you have director, it could be managing director, executive director, full-time director, part-time director, doesn't matter. Every director is what? KMP. So the company and KMP will become what? Related party. The Vamsha Vriksha does not stop there. Relatives of KMP and company also will become. Same like individuals you took this example. Same example holds true for what? KMP also. Like here, check. A Limited has a managing director called Mr. Z. A Limited has a managing director called Mr. Z. That means Mr. Z is what here? KMP. Is Mr. Z and A Limited related party? Yes. Only that, or even Z ka family members. Z ka relatives, and the company also will become related party. That's what related. A Limited and Z ka relatives, all are what? Related to each other. This is the case where how an individual and a company can become related to each other. Next will be what? So how can two companies be related to each other? This was one individual and another was company. Next is what? Two companies. So can two companies become related party? Yeah. How? If one company is able to control or exercise significant influence, then both the companies will become what? Related party. Same drama. If one company is able to control other company, like holding subsidiary companies are related party. Significant influence, when will you get? Or how will you get? With voting power, how much? 20% only. If you have control, then other company we call as subsidiary. If you have significant influence, other company we call as associate. They are all related. Like you are in a X has 90% voting power in Y Limited. With 90%, what do you get? Control. So are these two related party? Yes. X Limited has 30% equity shares of Y. With 30%, what do you get? You get significant influence. That means these two are they related party? Yes, they are related party. That's the first proposition. That's how. That is first aspect, which is who is a related party. There's one more actually. The enterprise over which KMPs either have control or significant influence, they are also related party. This one I will take a question on this, easier to understand the question. This one let me for time being there. So one aspect we have covered, which is what? Who is a related party? Second one will be who is not a related party. That is there in this touching the box. What is it? Simple. If two companies have common directors, those two companies don't become related party. Like here, let's say Mr. X, all directors are KMPs. Mr. X is a KMP in A Limited. Say Mr. X is also KMP in B Limited. Now, are these two related parties? Yes, company and KMPs are related to each other. Are these two related parties? Yes, company and KMPs are related. We are not talking about that. We are talking about A and A Limited, B Limited related party. As a thumb rule, two companies just because they have the same director, they do not become related party unless otherwise you prove it. As a thumb rule, basic rule, they are not a related party. If you want to say A and B Limited are related to each other, you should prove it with some data. Okay, but as a thumb rule, these two are not a related party. Before one second. Okay, go on. Little louder, you will. That is a question. No, it's not related to this. Some other question. Wait, this is okay. Okay, next one. Sir, I took 100 crore loan from SBI. Huge loan. SBI and me are related to each other. Banks, what is the main job of a bank? Except deposit and give out the loan. So providers of finance, major customer, major suppliers, agents, distributors, your government departments, all these are not related party, even if the volume of transaction done is on the higher side. Even if the volume of transaction is big, they are not a related party. Related parties are, yeah, suddenly they started banging the things there. Last minute it's reaching, otherwise, some thumbs up, others are saying you do whatever you want. Okay. Okay, so what is this rule again? Providers of finance, major customers, major suppliers, franchisers, distributors, agents, government departments, trade unions and all, they are not a related party, even if the volume of transaction done is on the higher side. Like let's say A Limited sells 90% of the goods to B Limited. 90% of the A Limited goods is sold to whom? B Limited. That means B Limited is our data. Will these two become related party? No, because it is a major customer. Just because you have a major customer whom you are doing with high volume of transaction, they don't become related party. If you want to prove that they are related party, you have to prove it with some evidence. As a thumb rule, as a basic rule, the major customers, major suppliers, these guys are not a related party. This section is also over. That is, who is not a related party. Last section. What is the last section? Heading. What is the heading of AS 18? Related party disclosure. Now, if it is a related party, you have to get some data. Not only calling it as a related party disclosure. That is the same. Now, what disclosures you have to give? What AS 18 says? First, to find out how are you related party. First, find what? How are you related party? You can become related party to multiple means. You can be KMP. You can be relative. You can have significant influence. Or you can have control. There are multiple ways to which you can become related party. First, to find how are you related by. If the relationship is established to control, if the related party relationship is established to control, then whether you have done a transaction or whether you have not done a transaction, it doesn't matter. Two data you have to compulsorily give every year. What did I say? If you are a related party, how? To control. Then whether you have done transaction or whether you have not done transaction in the current year, doesn't matter. Still two data you have to compulsorily give. That is name of the related party, nature of the relationship. What is the name of the related party? Company, name. Or individual, name. Nature of relationship means you simply say they have established a relationship to control. As well as. Okay, so this is data you have to give even if you have not done any transaction with the related party. Whether you have done or whether you have not done a transaction, this disclosure is a must. Okay. When it comes to others means what? KMP, relatives, or significant influence. If the related party relationship is established not by control but to other means, then you will give the disclosure only if related party transactions happen. You will give the disclosure only if transactions occurred in the current year. Only if you have done some transaction with the related party in the current year, then only you will give a disclosure. And disclosure is a common sense. You tell me, sir. In my example, this way. What data as a user of financial statement you would like to know? What data you would like to know? You don't want any data, no? The best way, no? Yeah. Same. So first is name of the related party, and then nature of relationship. How do you become related party? Through KMP, relative, what is? Third one, what is the nature of transaction you have done? Have you sold goods to a related party? Or have you purchased goods? Or have you given loan? Or have you taken loan? Have you disclosed? Nature or description of transaction. Fourth one, you disclose how much is the amount of the transaction, monetary value of the transaction. Fifth one, usually sometimes what happens? You give the loan. We have seen this in old cases when that control measures were not stringent. Company used to give the loan to the directors and then write it off. And then write it off. So if you have written off any transactions, if you have written off any amount related to what? Related party, give a disclosure. So if you have done any provision for doubtful debts or written off any amount, give a disclosure. So this disclosure you will give when? Only if the transaction has occurred. Fine? All this. Otherwise, not. If transaction is not there, disclosure is also not necessary. That's it. Concept checking. That's all that we need to know from this time. And we get to the numericals. Some questions backing this. Okay. One company A Limited entered an agreement with Bola. Okay. One company A Limited entered an agreement with Bola for running a business for a fixed amount payable to the latter every year. So you are giving some money to Mr. Bola and saying, run my business. I'm busy, you run my business. The contract states that the day-to-day management of the business will be handled by day-to-day simple transactions are handled by Bola. But by all the financial and operating policy decisions are taken by the board. All major decisions, board will take over. All simple decisions, operations, who's taking care of Bola. The question is, they're saying, is Bola and company related party? Bola and company are related party. See, Bola has any significant influence, any control? No. The only way Bola can become a related party here is if he's a KMP. Is Bola really a KMP here? KMPs are those persons who do the planning, control, and directing the activities of the enterprise. When these activities, major activities. Here are all those major policy decisions Bola is taking or board is taking. So what is the conclusion? Bola, is he KMP or not a KMP? That means are they a related party or not a related party? Not a related party. Let's answer the first question. First part of the question. Second part. Shri Manojo, he's a relative of KMP. He's a relative of KMP. The company and KMP are they related party? Yes. Relatives of KMP and company are they related party? Yes. So Mr. Manoj, he's a relative of KMP. He has received how much remuneration? 350 for his service in the company from April to June. On 1st July he left. So there is a relative of KMP who is giving some service to the company for a whole year or only 3 months. Then after that he left the company. Now they are saying, should we give a disclosure? First of all, is the company and Manoj a related party? Company and Mr. Shri Manoj are they related party? Yes, because Manoj is a relative of KMP. A relative of a KMP and the company automatically become related party. Okay. Is it established to control? No. True relative. Means you will give a disclosure only if what? Transaction has occurred. Has the transaction occurred? Yes. It's not mandatory that the transaction should occur whole year. It's not necessary that the transaction between related parties should go for the whole year. If transaction has happened for 1 day, you only give 1 day disclosure. If transaction has happened for 3 months, you only give a disclosure of 3 months. What is the final conclusion? Shri Manoj and company are related party. Related party relationship is necessary to be there for the whole year or it need not be? It need not be for the whole year. Here it's only there for 3 months. If a transaction only for 3 months, the 3 months per transaction you disclose. No need to give a transaction disclosure beyond that. Okay, Haji. Done. Next. Oh, this one. Identify the related party in this case. Again, my question. A Limited has 51% in B. B has 51% in O. Z has 49% in O. Whenever they give you this one, always draw flowchart. It'll be much easier to connect. A has how much in B? 51%. B has how much in O? 51%. Okay, arrows going like that. Who has balance 49% in O? Z. Z has 49% in O. Arrows going up. Okay, now, first, let us see. For A Limited, who's a related party? For A Limited, who's a related party? Is A able to control B? Yeah. Can A control O? Yes. A can control B. Through B, A can also control O. Yes, no. I mean for A limited, who's a related party? For A limited, B limited, and O limited are related party. Or if you wanted another simple thumb rule, holding companies and subsidiary companies are all related to each other. Holding companies and subsidiary companies are all related to each other. They are all one group. This is holding subsidiary group. The group in group everybody is related to each other. That we also get a number if you want. Let's test it for B. For B limited, who's related? A. B is controlled by A. E can control O. That means A and O are related party for whom? B. For O limited, which are who and all are related. So O is controlled by A and B. And Z can have significant influence over O. That means what? For O limited, who are all related? A, B, and Z. A, B, and Z are related for O. Last two. For Z limited, who's a related party? Z has significant influence over O. So O is a related party for Z. No layer. Like here. A limited has 90% shares in B. B has 90% in C. C has 90% in D. Like this, you can put A. You can go on, doesn't matter. Or this is a holding company. All these three are what? Subsidiary company. All are one group. They are all related to each other. You can extend it beyond that. How much you want? You remember one point I put on hold? What is the point I put on hold? The companies over which KMPs either have a control or significant influence, reporting entity and the company will become related party. Here, this one. The enterprise over which KMPs have control or significant influence are related party. This one we are trying to understand. Therefore, one question. Look at this. Narmada sold goods worth 90 lakhs to Ganga. Okay, the two companies are Narmada and Ganga. Managing director of Narmada. So managing director means you are a KMP. Is KMP and the company related party? Yes. The managing director of Narmada owns 100% of Ganga. So first let's draw a chart. Do you think these two companies are connected to whom? Managing director. So here let's call the managing director as Mr. X. Some name will get this for identification purpose. Mr. X is a managing director where? In Narmada. But that same managing director owns 100% of Ganga. What the provision says is, if there is a KMP, if that KMP, take one second, are these two related parties? Company and KMPs are related party. Are these two related party? Yeah. Mr. X has control over Ganga Limited. So are they related party? Yes. The question is these two related party? The question is Narmada Limited and Ganga Limited related party? That is back to my provision. What provision says is, if there is a KMP or the enterprise over which the KMP has control or significant influence makes the reporting entity and other company related party. Very simple. Mr. X is the managing director here. Mr. Director is also controlling another company. If the managing director has 100%, what do you get? Control. If the managing director has control or significant influence over another entity. If the managing director has a control or significant influence over another entity, then these two entities will become related party. That is what the provision is trying to say. One small party. One small party. Because it's quite common sense. Mr. X can influence Narmada also. Mr. X can influence Ganga also. If Narmada and Ganga are doing some transactions, can't Mr. X say, do the transaction at below market price? Possible. Possible, because he is having control in one company, influence over another company. So there's a possibility of X influencing here. That's the reason the provision says these two companies will automatically become what? Related party. But for these two to become related party, one of the two things should be there. What is that? Either control should be there or XI should be there. Suppose Mr. X is a KMP. Mr. X is a KMP in Ganga. We already studied that provision. Just because two companies have common directors, common KMP, they don't become related party. For you to become related party, this side either should be a control or a significant influence. Done now. Can I read the question further? So what is the takeaway of this example or final point of this example? Are these two related parties? Yes. Okay, let's read further. Has any transaction happened between Narmada and Ganga? Has any transaction happened between Narmada and Ganga? Yes. Narmada has sold goods to how much? 90 lakhs to Ganga. Are these two related party? Yes. Has transaction occurred? Yes. That means can you ignore? Can you escape from the disclosure or compulsory disclosure? Compulsory disclosure. Now you know what they will say in question. We will not. Some goal they will give. Let's see what goal they will give. The sales were made to Ganga at normal price. So have you sold it at below the market price or normal market price? Normal market, fair price. This is called as arm's length transaction. At fair price basically. The chief accountant of Narmada is contending. He's of the viewpoint that the sales need not require a different treatment from other sales made by the company. Hence, no disclosure is necessary as per the standard. The chief accountant is saying we will not disclose. Why? What is that justification? Because the sales has happened at below the market price or market price. Since we have done the transaction at market price, accountant is saying we will not disclose. Standard is not worried about at what value you have done the transaction. If there is a related party, then you have to compulsorily give a related party disclosure. Transaction can be done at market price, below the market price, above the market price. It is irrelevant. Disclosure still is not compulsory. That means his contention of viewpoint is correct or wrong? Wrong. Disclosure has to be given. What disclosure we already discussed? Name of the related party, nature of relationship, nature of transaction, amount of transaction, any write-off. Everything will not be there, but those are the common points. Okay, G. Now this already, I think we already discussed this. So is it mandatory that the relationship should exist for whole year? So here relationship exists only for one quarter. Relationship exists only for, or maybe I'll read off this example. Some companies there, okay? Goods sold amounting to 50 lakh to associate company. Associate company means we have what? Control or SI. We have SI. So that means these two companies are they related to each other? Yes. And have we done any transaction? Yes. And when have you done transaction? First quarter. So what sort of transaction have you done? Sale of goods. Okay. Which quarter? First quarter. After first quarter, the relationship ceased to exist. Ceased to exist means relationship stopped. So how can the relationship come to an end? We sold the shares of associate company. When you have shares, you will get significant influence. Suppose A limited has 25% shares in B limited. So with 25%, what do you get? SI. So first quarter maybe had this. Second quarter, A limited sold 25% shares of B limited. Now you tell me, A still has significant influence over B limited or SI lost? SI lost. Okay. I mean, it is RP or not an RP? Second quarter onwards, it is A and B are not related party because the significant influence is lost. Okay, that's everything so far. However, goods were supplied as was supplied to any other ordinary customer. So sale transaction stopped or still continuing? Sales is still happening, but related party relationship came to an end. Sales has occurred for the whole year, but relationship existed. A related party relationship existed only for first quarter. Now the question is, will you give the disclosure of sale transaction for the whole year or only for first quarter? Only for first quarter. As long as the related party relationship exists, you need to disclose. That relationship exists only in which quarter? Only first quarter of sale transaction, you need to give a disclosure. Beyond that, since the relationship is not there, disclosure is also not necessary. Beyond first quarter. That's all the takeaway of this example of okay, sir. So when significant influence is lost, how we should account, sir? I'll not up here. See fine. Not there in the syllabus. Okay, is there in CA? Fine, let's stop there. Question number 14. One last week. I think we have time. One last week. UK Bank, name of the bank, holds 23% equity shares of P with 20% what do you get? Significant influence. So we read one provision if you remember. Who is not a related party? What is that? Providers of finance, major customers, suppliers, agents, they are not a related party. Yes. Now check. This is just a question targeting that. The bank has provided a loan of 20 million to P limited. So P basically has taken a loan from bank. What much? 20 million at market interest. Now, will you give a disclosure? This is the question. That's okay. Will you give a disclosure of this or ignore? No. You're saying, am I saying no? Others? Yes. Why? Sir, normal rule is bank and company are not related party because it's a normal job of a bank to give loans. If bank had only given a loan to the company, then they are not related party. Here, bank has given only the loan, or bank also has significant influence. Since bank has significant influence over P limited, When you have significant influence, won't you become a related party? Yes. If you are a related party and if you have done a transaction, you will ignore the transaction or disclose the transaction. So you need to give a disclosure. Though bank is a provider of finance, still they are a related party. They can justify. How can they justify? Because bank has significant influence. If this was not there, then bank and company are not related party. Because of this point, bank and the company will become related party and transaction is to be disclosed. Thank you for your time and patience. So let's hello people, let's continue our discussion on the marathon series. Now we are revising accounting standard 19, which talks about leases. Hello people, so welcome back after that break. So let's continue our revision discussion. So next we are revising accounting standard 20 or earnings per share, EPS. So again, EPS is just a number you calculate and report in your P&L. In your P&L account, the last item you will disclose or you publish is earnings per share. So there is a certain way to calculate this that you need to calculate and publish in your P&L at the end. Okay. So as far as AS20 goes, there are two kinds of EPS we calculate and we report. One is basic EPS, for class purpose we call it as BEPS, and one diluted EPS, for class purpose we call it as DEPS. DEPSO. Basic EPS, diluted EPS. Again, it's out and out numerical standards. You do get calculation wise questions from the standard. That's the usual way of asking a question from here. Okay, so let's go further. And the name is earnings per share. So you calculate earnings for one share. How do you calculate earnings per share? Total earnings divided by total number of shares. So the calculation is yes. When you basically when you try to interpret the formula, you don't like that. But your basic EPS is given by the formula, not earnings. Each. What? Each. Earnings available or earnings attributable to equity shareholders. Numerator is not earnings, it is each. Denominator is not total number of equity shares, it is weights. Weighted average number of equity shares. Each upon weights gives you basic EPS. Okay. So it is not earnings, it is earnings available to equity shareholders. Why? So we report or rather we calculate and report EPS only for equity shares, not preference shares. Hence we don't take total earnings, we take earnings available to equity shareholders. Exactly. So how do you get earnings available to equity shareholders? Is profit after tax available to equity shareholders? No. From profit after tax, you have to pay preference dividend. So from PAT, as a profit after tax, if you reduce what? Preference dividend, you get a number, no? That number only we call as what? Each. Earnings available to equity shareholders. Earlier there used to be dividend distribution tax concept also. Now it's abolished, so this may not be relevant. Some old, some years before, if you see some questions, dividend tax adjustment also used to be there. Hence I brought in this. In today's context, this may not be relevant for you. Okay? Alright, so you got to calculate each. Denominator is what? It is the number of shares or weighted average number of shares. Weighted average number of shares. For class purpose, we are calling it as weights. Don't use short forms in exam. It's only for the sake of easy remembrance. Now why we take weights? Because people, a company issues shares. Now let's say two companies. Let's take a simple example. There are two companies. Both the company wants to issue new shares. Both the company wants to issue new equity shares. First company issued the shares on the first day of the year, first April. Company number one, they gave new equity shares when? On 1st April, meaning the first day. Second company, they issued new equity shares on the last day. Both are worth 10 crore rupees. New equity shares is worth how much? 10 crore. Which company will earn more? The company issuing equity shares first or last? First, why? So if you issue the shares on the first day, company will get money also on what day? First day. That means they can utilize this money for the whole year. If company issues shares on the last day, they will get money on the last day. Can that money be utilized in the current year or cannot be? That means earnings is influenced by the time of what? Time of issue. Correct? If you issue on the first day, you'll earn some money. If you issue on the last day, you'll earn same money or lesser money. Since earnings is affected by time, in the denominator we don't take total shares, we rather assign weights in what time. Since earnings is affected by time, the denominator also should be expressed in time. Hence we don't take total number of shares, rather we take weighted average number of shares. Because to compare numerator and denominator, they should be on the same platform. No? So if this is affected by weights, this should also be affected by weights. Hence we take the weights of it. Nanaji, I'll give you another example in regular class. I will not go. This makes sense. What I said just now. Okay. So how do you calculate weights? So weights are usually assigned in months. We give the weightage in months, 1 by 12, 2 by 12, 12 by 12, like this. Okay. But sometimes they give you odd dates. Like shares are issued on 22nd April. Shares are issued on 22nd April. It's like can you easily express it in months or it's little odd. In that case, you will still give the weightage in days. Okay, they give first day or midday or last day. 1st April, 15th April, 30th April. Like this, if they give you the data, they will give the weights in what? Months. If they give odd dates, 10th April, 15th April, or 17th April, like this, then they assign the weights in days. But days, weightage problems are very, very rare. We don't see it often. In majority of the problem, weights will be assigned in what's months only. Okay, there are two ways to calculate weights. Both will give you the same answer. You can use any of the two. One is an individual approach, another one is cumulative approach. Individual, another one cumulative. How it works? Let's look at a small example. Okay. They probably don't like the example. On 1st April, I'm more worried about the costing class happening there. Please, this is marathon. This is okay now. Manage proper. That side regular class is going on. How they are managing. Okay. I think this drilling work. No, I think me and drilling work goes hand in hand. Last time I did in Bangalore, some drilling work was going on. I think before that also was some drilling. Third time, this noise is me and noise are going hand in hand. Wherever I go, probably noise follows. Okay, that means look like I only have bad wasu. Okay, see, they're agreeing. I don't know whether this is getting captured or not. Maybe it's available in recording, but I'm not sure. Okay, let's say on 1st April 2024, company has 1 lakh shares. A company issued how many shares? 1 lakh shares. Again, 50,000 shares was issued on 1st October. So two times in the current year shares are issued. One's on 1st April, another one on 1st October. Now we can't. Can we take 1,50,000 shares for EPS calculation or assign weights? Assign weights. Any odd dates you are seeing or perfect dates. So we will give the dates. We assign the weights in days or months. Months. How do we do that? First, let's try individual approach. Individual approach is like this. 1 lakh shares was issued on what day? 1st April. That means it was there for the whole year. Whole year has how many months? I mean on this 1 lakh shares, how much weightage will give? Well, that's all. All your number is there. 50,000 shares came when? 1st October. That means this shares will be available from from 1st October to 31st March 2025. Count October, November, December, January, February, March. How many months? 6 months. That means on 50,000 shares, how much weightage you give? 6 months. So you give 6 by if you add up, you'll get the total weights to be how much? 1,25,000 shares. This will be utilized for our basic EPS calculation. This is one way of approaching the weights, which we call as what approach? Individual approach. Another approach is cumulative approach. You can follow any one of the two. Cumulative approach is like this. That listen to my sentence carefully. From 1st October till 1st April till 1st October. From 1st April till 1st October, company had 1 lakh shares. Do you agree with me? After that number changed because we issued extra. Do you agree? Once again, I'm going to tell from 1st April till 1st October, company had how many shares? 1 lakh shares. Then afterwards they issued 50, so number of shares will increase. So count from here to here. Count how many months? April, May, June, July, August, September. 1st October, you leave how many months? 6 months. So for 6 months, company had how many shares? 1 lakh shares. So you take 1 lakh into 6 by 12. Done. From 1st October onwards, company has 1 lakh shares or 1,50,000 total shares. Cumulative means total approach. How many total number of shares is now available from 1st October? 1 lakh plus 50,000 is how much? 1 lakh 50. Any more transaction happened or that's all? Means from 1st October onwards till end of the year, company had how many shares? 1 lakh 50,000. So from here to here, you count how many months? October, November, December, January, February, March, how many months? So for the next 6 months, company had how many shares? You calculate how many, how much are you going to 125. This also give 125, that also give 125. Whichever way you want to calculate weights, you can do it, whether individual or cumulative. Both are acceptable. This is your weights for now. Okay, Ji? There are 4 to 5 types of questions usually that gets targeted from this particular chapter. Bonus shares, right shares, something around dilute APS, a couple of questions, and one more discontinued operation of questions. Yeah, usually they clear on this with this 5 questions. Okay, based on time, we will see how much we can cover. Can we start with the first type now? Called bonus shares. Called what? Bonus shares. So bonus means WOSI. WOSI means free. WOSI I think same in every South Indian language. Free on your free. Okay, same. Everywhere I think the same. So bonus shares means additional shares given to existing shareholders for free. That's all. Okay. Now we are trying to ascertain how shares given to existing shareholders for free. That's all. Okay. Now we are trying to ascertain how bonus shares has an effect on EPS. Okay. Ji? Now, sir, why do we assign weights to the shares? Forget about bonus. Why do we really assign weights to the shares issue? What is the thought process behind that? So depending on when you receive the money, on shares, your earnings can increase or earnings can reduce. Remember company 1, company 2 example. Company 1, when did they issue shares? First day. Company 2, last day. Who will earn more? Company 1. Why? They receive the money early. Yes or no? But bonus shares, when a company issues bonus shares, company collects money or no money? No money. I mean, honestly speaking, should we assign weights to bonus shares? Is company getting any money from bonus shares or no money? No money. So in one sense, if you analyze bonus shares, you don't have to worry about weights. Because by issuing bonus shares, company is not even receiving a single rupee money. No. Yes, that's one approach. Another approach would be is, sir, will you directly get bonus shares or first you must already have original shares? Only if you have original shares, only if you have some shares already, then only you will get what? Bonus shares. Now I don't have any shares in Reliance. Reliance has come out with a bonus issue. Will I get bonus shares of Reliance or I will not get? Not get. Why? Bonus shares is given to the existing shareholders at free of cost. So only if you already have original shares, then only you will get what? Bonus shares. Hence better linkages. Since bonus is linked to the original, whatever weightage you are giving on original shares, same weightage you give on bonus shares. That's the better approach. Is this okay with you? These are much tested at very finite level in your thing, but this will have impact in CFD. So better know this one. Keep this in mind. On original shares, if you assign 12 by 12 weightage, on original shares, if you're giving 12 by 12 weightage, bonus also 12 by 12. On original 10 by 12 means bonus also 10 by 12. Keep this in mind. It's not, I don't know if they may ask such questions here also, but so far it has not come. But if you know this sentence, you can avoid certain mistakes. Easy. Everybody good. This is one point we need to keep in mind. Whatever weightage on original, same weightage on bonus. Second point. So whenever bonus issue has come, you have to restate last year EPS. Previous year EPS you need to restate. This is for comparison purpose. I'll give you an example in regular class to prove why we do this. I'll not go into that for the time being. I just tell you what needs to be done. Whenever bonus shares has been issued, bonus shares are issued in the current year. What do you have to do? Not only you have to calculate current year EPS, you need to recalculate. That's what we mean by restating. Restating is recalculating. Which year EPS? Last year EPS also you need to restate. This is done for comparison purpose. If you remember the example, I told you 50%. Okay, now everybody, these are the two things you need to do. This is purely for the sake of comparison. One quick way to remember, one easy way. If you don't want logical magical, just one quick way, a quick fix to remember this is whenever you're calculating EPS for the last year, in which case, bonus case, simply think that, don't tell I told this. Okay, this is only for your easy remembrance. Think that bonus was issued in the last year and calculate. What did I say? Think that bonus shares was issued in the last year and do the calculation. That's all you need. I told you the logic, but I'll not go into the logic. We'll not have time for every logic here. Okay. Same. This drama, what you're doing for bonus shares, we have to do the same drama for share splitting. Share splitting means one share will become two shares. Same drama. Whether it's bonus or share split, we do the same drama. So two pointers for bonus. What is that? One, whatever weightage on original shares, same weightage for bonus. Second, restate previous year EPS. How you restate? Simply think bonus was given in the last year and recalculate. That you'll get the right answer for the time being. Now let's do it. Let's go for one question. Just have a little clarity. This is our class notes question. Similar question you might find in materials. I say material also. Take care. Equity share capital of Aditya is 10 crore. It's not 10 crore. It is rupees. 10 crore. That means what is the number of shares or equity share capital? And how the face value of each share? 10 rupees. That means how many shares? 10 crore divided by 10. We have 1 crore shares. Oh. During the year 13-14, company has issued bonus shares in what ratio? None. So if you have one original shares, you get how much bonus? One bonus. How many original shares we have? 1 crore shares. So how many bonus will you get? 1 crore bonus shares also you will get because the ratio is 1:1. Bonus came when? Which year? Correct. That is what? 2013-14. The net profit after tax for the year ended 31st March 2013, for the year ended 31st March 2014 is 8.5 crore and 11.5 crore. So for EPS calculation, we need PAT or we need each. We need each. How do we calculate each? PAT minus preference dividend. Are they given any preference dividend data here? If they don't give the data, preference dividend is 0. Means in these problems, PAT only will become each. PAT and each are same because preference dividend is not there. Okay, that's W. EPS they only calculated for 2 years. Current year and last year. How much? 8.5, 5.75. You need to comment. Meaning you need to recalculate and check whether they've done it correctly or not. So let's recalculate. First let's do for current year. Current year is year ended 31st March 2014. How much is each for current year? 11.5 crore. And then we need one more data for EPS. What is that? Weights. Here we have one shares or two types. One original, one bonus. How many original shares we have? 1 crore. Did they say this original shares was issued during the year? Any data given or no data? I mean, what is the assumption? Original shares was there from the beginning. This 1 crore share was there from the beginning. So how much weightage? 12 by 2. If you have 1 crore original shares, how many bonus shares will you get? 1 crore. On original shares, how much weightage are you giving? 12 by 2. So on bonus also, how much weightage will you get? 12 by 2. So when you calculate, how much are you going to get? 2 crore. Any problem? How do you calculate EPS? Each divided by weights. These two division will give you 5.75. How much did they calculate? 5.75. So it looks like current year basic EPS, what they calculated is correct. Yes, sir. Now, there are 2 pointers for bonus shares. What are those? 2 pointers I told you need to remember for bonus shares. One, weights. Whatever weights on original shares, same weight on bonus shares. Second one, restate last year's EPS. By what process? By what thinking? Simply think bonus shares was issued in the last year and recalculate. Okay, last year how much is each? 8.5 crore. Last year how many shares? How many original shares you had? 1 crore. That's all or 1 plus 1 now. Now bonus shares also think that it came in the last year and calculate this for comparison purpose. So what about weights? If you want to write 1 crore into 12 by 12 into 1 crore into 12 by 12. If you're doing 12 by 12, then as per saying you're doing nothing more. So how many number of shares? much weighs? 2 crore. Calculate the EPS. How much I get? 4.25. Correct. Numbers looks good. Yes, everybody. How much did they report? They reported 8.5. That means they did not do the second part. What is the second part? Whenever bonus comes, you need to restate or recalculate last year's EPS. Was that done or not done? That's what you need to do. Hence, the treatment given by the company is following accounting standard 20 or violated. Right. In that, you'll sentence and finish off. This is one kind of question. I feel now and all, I think if at all you ask this question, it will come as an MCQ question. In case studies, fit in 2 marks. Beyond that, helpful. One type of problem done. Can we go on to the next? Next slide. Next is something called right shares. What? Right shares. Right shares also more or less has the same meaning. Right shares is also additional shares given to existing shareholders, but not for free, but at a discounted price. Compared to the market price, you will issue it at a lower price. Let's say face value of the shares 10. Face value of the shares 10. Market price is let's say 470. The stock exchange price of this particular share is how much? 470. Right shares will not be issued at 470. It will be issued at a lower price, at a discounted price. Let's say right shares was issued at 4. Instead of issuing it at market price, you will issue it at a little discount. Discount is not below face value. Okay, discount is from what perspective? Market value. So shares cannot be issued at discount. So what Companies Act says is you cannot issue shares below the face value. Here we are not issuing the shares below face value. We are giving discount from what? Market value. Little lower than market value. We are giving that could be 400, 300, whatever. That only referred to as what's right shares. Again, the meaning. What is the meaning? Right shares are additional shares given to existing shareholders at a discounted price compared to the market price. Okay. So for bonus shares, we said there is no weightage or drama, right? Because by issuing bonus shares, company is not receiving any money. Can we say the same thing for right shares? Is that statement holding good for right shares also? No. When it is right shares given free of cost, or company is collecting money? Company is collecting money. Yes or no? But appropriate money or little lesser money? Little lesser money. That means here, weights for drama should be ignored or correctly considered. The date of rights issue makes a lot of difference. Okay, people? Yes, sir. Right, sir. But what is the market price? 470 here. What's the right price? How much discount you give? That's 70 rupees you're issuing discount. No, that represents your bonus thing. So right shares will also have an element of bonus. If you remember in regular class, you shirt example. Even if you're taking class number. So there I proved you that right shares also will have an element of bonus. Or simply I think making the example only you can include. The 70 companies collecting or not collecting? Not collecting. That represents what element? Bonus. Now you tell me, if you are setting the paper, which question will you set? Bonus shares question or right shares? Right shares. Why? Right shares also has an element of bonus. So whatever you do for bonus has to be also done for rights also. That means this is a better way of testing the students because both concepts testing. I told you one logic method of solving this where no formula is required. But I also told you that ICI gives the right shares answers only in formula. So don't use the logic. So we have to remember a couple of formulas here and present the answer only in formula. And without formula also you can get, but that method if you write maybe you'll get 0 marks. Answer will match, but English level will not understand what you did. So that way, I just told it for your reference. But these two formulas you need to remember for right shares. Okay. One first formula that you need to remember here is something called theoretical XI price per share. Theoretical XI price per share. You remember the formula value of original shares plus value of right shares divided by number of existing shares plus number of right shares. 2 months. Very simple. Average shares. Very simply average price. So you had 1,000 shares. You purchased each of them by paying 15 rupees. How much? 15,000. You purchased 500 more shares by paying 20. You purchased 500 more shares by paying how much? 20. How much money? 10,000. So totally how many shares? 1,500. How much money? 25,000. What is the average price? For 1,500 shares, totally you are paying how much? 25,000. So that means if you want average price, 25,000 is the price for 1,500 shares. For one share, how much? 16.6. So this formula. Okay, Najee. Now how did you get this? Express this formula. How did you get 25? How did you get 25? 15 plus 10. How did you get 15? What is this? This is the value of what shares? Original shares. That's the numerator. First you have to take value of the original shares. To this what do we add? What is this now? Right shares. Right shares for number, right shares for value. So first numerator is simply what? Value of original shares plus value of right shares. If you do that, you get what? Total value. What do we need in the denominator? Total number. Now we have 2 shares. To get the total, what do we do? And what are those 2? Value of number of shares before rights issue plus number of right shares. That's all we have. It's simply average price, but given to a fancy name called what? Theoretical XI price per share. Okay, formula once again, let's see. How do you get theoretical XI price per share? Numerator is value, denominator is number. They have one or two. One is original, another one is right. First you have to find value of original, then add value of right divided by number of original shares plus number of right shares. That's your formula. Okay, this is your average price or in AS20 terminology, theoretical XI price per share. Okay. Second one we just now discussed. Right shares also has an element of bonus. That in AS20 terminology we call it as AF. AF as in adjustment factor. Adjustment factor. Instead of bonus element, they are calling it as adjustment factor. That's given by the formula. Value of the shares before the rights issue, value of one share before the rights issue divided by theoretical XI price per share, which you compute above. Like let's say, so before the rights issue, the price of this one share was 30 rupees. Before the rights issue, the market price of one share was how much? 30. Now you calculated average price, that we call it as what? Theoretical XI price per share. Let's say you want it to be 20. So calculate this. How much are you getting? 1.5. This 1.5 is your adjustment factor. Now, if you want one quick way, easy way to remember this is, so adjustment factor shall always be greater than 1. If you're getting any number lesser than 1, you've done some mistake. Don't even, then you'll get to know whether what should be Numerator what should be? Denominator. You're confused. Okay. So that is one quick fix. Adjustment factor should always be greater than 1, right, sir? So right shares has an element of bonus. That means one share is worth 1 now, or one share is worth more than 1. There's also bonus included. So 1 is not 1 now, 1 is little more than 1, maybe 1.05, 1.50, whatever. Adjustment factor is trying to capture bonus only. Hence adjustment factor should always be greater than 1. That's your checkpoint before you proceed further. Okay, G. Now if there's bonus, you know what to do. Bonus is always linked with what? Original shares. Right? How much ever weightage you are giving for original shares, same weightage should be given for bonus shares. Now do that adjustment. That's all. That's what I've written here. This will learn it to numbers. Can we go ahead and test this particular in one other question? Come to question number 6. Again, class notes. Similar question you have in study material also. Come to basic EPS from the following data. Net profit for last year is 20. Okay, G. Now if there's bonus, you know what to do. Bonus is always linked with what? Original shares. Right? How much ever weightage you are giving for original shares, same weightage should be given for bonus shares. Now do that adjustment. That's all. That's what I've written here. This will learn it to numbers. Can you go ahead and test this particular in one other question? Come to question number 6. Again, class notes. Similar question you have in study material also. Come to basic EPS from the following data. Net profit for last year is 20 lakh. This year is 30 lakh. So why are they given for last year, sir? Whenever there is bonus, you have to restate last year EPS. So hence they're giving last year data. First, let's do it for the current year. Then let's worry about the previous year. So last year, so whenever they give you net profit, net profit always means PAT. In every case, in whichever chapter it is, doesn't matter. Net profit always means PAT. If preference dividend is not there, PAT only will become each. Usually in these sort of problems, preference dividend we don't see. Not that it can't be included. Usually it is not included. But watch out. Whenever there's preference dividend, you'll have to do an adjustment. What adjustment is that? From PAT, you have to reduce preference dividend. Remind me once. For preference shares, there's one extra provision. I'll tell you. In case I don't, just remind me once after I finish all this. Okay. Number of shares outstanding prior to the rights issue. Before the rights issue, how many shares we had? 10 lakh shares. Now the company is coming out with the rights issue. What is that? 1 new shares for 4 outstanding. If you have 4 shares already, then you are eligible as a shareholder. You are eligible to buy how many rights shares? If you have already 4, you can buy 1 more. That's the issue. 1 is to 4 or 4 is to 1, depending on what you're interested. So if you have 4 shares, you can buy how many shares? 1 right shares. You have 4 shares, or you have 10 lakh shares. If you have 10 lakh shares, how many right shares can you buy? 10 lakh into 1 by 4 becomes how much? 2 lakh 50,000 shares. You don't have to calculate, they won't give you. That is 2 lakh 50,000. And what is the rights price? 20. If you want to buy 1 right share as a shareholder, how much you need to pay the company? 20 units. Last day for exercising the right is 31st March. If you want to buy the right shares as a shareholder, you'll have to buy within what day? 31st March. That's the deadline. Fair rate of 1 share immediately prior to exercise of rights was 25. Before the rights issue, the market price of the fair price of 1 share was how much? 25. Calendar year is being followed. That means you're following Jan 2. Yes. Can we answer this question now? Okay, first, as I told, for right share. two formulas. What's the first formula? Theoretical X right price per share. How do you calculate that? Take a calculator. Value of the original shares. How many original shares we have? 10 lakh. Okay. And what was the value of one share before rights issue? 25. So how much is the value? 10 lakh into 25. That's 2.5 crores. There are multiple ways to do it, but anyway, 2.5 crores. That's it. Plus value of right shares. How many right shares? 250. What is the value of one right shares? 20. So total value will be how much? 2,50,000 into 20. How much is that? 50 lakh. So value of original shares is 2.5 crore. Value of right shares is 50 lakh. Right? So total is 3 crore. Divided by what? Number of original shares 10 lakh plus number of right shares, which is 2.5 lakh. When you do it, how much I get? 24. That's what you get. That way you can do it in total. If you don't want to work with big numbers, there's another approach to calculate the same. Right shares is given in a ratio of what ratio? 1:4. That means you can take a simple number and work out. How many original shares you should have to get right shares? 4. What is the value of one original shares? 25. If you have 4 original shares, how many right shares can you buy? 1. And what is the value of one right shares? 20. Divided by number of original shares 4 plus number of right shares. This also you can calculate, you get the same answer. Do it at total level or take this ratio and work it out, you get the same answer. Whichever way you're comfortable, both. Yeah, apply it in regular class. First formula for numbers. Okay. You have it? All good? Okay, what's the second one? Adjustment factor. The trick is what? Number should be greater than 1. So mathematically, if you want to get a number greater than 1, numerator has to be greater than denominator. Numerator, the value should be 5. Then only you will get a number greater than 1. Okay, now, what is theoretical exit price per share? 24. What was the fair value of the share before the rights issue? 25. So what do you do? 24 by 25 or 25 by 24? 25 by 24. What is 25? Fair value of the share before the rights issue. That they also call it sum right price per share. Divided by what? Theoretical exit price per share. That way you can construct your own formula. So 25 by 24, how much is that? 1.04. Are you getting a number greater than 1? Yes. Why are we getting a number greater than 1? Because right shares also has an element of bonus. The 0.04 is there. No? The 0.04 is there. That is the element of bonus. These are the compulsorily presented formula format. Don't change. I think I'm discussing logic method also in regular class. I told you, so don't use that. Use this only for exam. Yes, sir. And lastly, EPS calculation. So EPS we need two data. What are those? EPS we need two data. Each and weights. Each and weights. First, let's do it for current year. Sir, do you know the each of the current year? For this year, how much is each? 30 lakhs. Okay, I've taken that. Okay, Najee. Careful here. Little careful here, everyone. Each is done. Now we want what? Weights. Now, people, how many original shares we have? 10 lakh. Yes. We are doing cumulative approach here, okay? You know what is cumulative approach? You know, for example, I'm using cumulative approach. How much original shares we have? 10 lakh. Now, people, original ka weightage, bonus ka weightage, different or same? Original ka weightage, bonus ka weightage, different or same? Same. Now, 1 minute. Have you already captured bonus element? Yeah. Good. 1.04. What is that 0.04? Bonus element. Right now, 1 is the original share, 0.04 is the bonus element. So totally you get 1.04. Agree now. The weightage for these two will be different or same? Same. So what do you do? Listen here. How many original shares we have? 10 lakh. Do you want to calculate original ka weight separately, bonus ka weight separately, or can we do it together? Together, because anyway both has what weightage? Same weightage. So take this original shares and multiply 1.04. Multiply 1.04. Do that for me. 10 lakh into 1.04. What are you going to get? 10 lakh, 40,000. That means what? 10 lakh is original shares, 40,000 is bonus shares. Put together, we are calculating weights. Agree now? We are not finding bonus shares separately, but we are capturing the weights together. That is the essence of what? Adjustment factor. That is what adjustment factor is trying to do. Easy, everybody. So, what 10 lakh is original shares. The moment you multiply by adjustment factor, what are you going to get? Original shares plus bonus shares put together. Okay, Ji? Okay, Ji? That's right. That's right. This is okay. This number is okay. 1 second. Hang on. Which are we following? April to March or calendar year? Calendar year. We are doing cumulative approach. We are doing cumulative approach. When does the year start? 1st January. What is the last day for rights issue? 31st March. That means from 1st January till 31st March. How many months? Jan, Feb, March. So, what are you saying? What we are saying? 3 by 1. Agree now? 3 by 1. If you do this, you will get what? Original ka, bonus ka, weights. Under which approach? Cumulative. Easy. Everybody good? After 31st March, company will have 10 lakh shares or shares will increase? Shares will increase. Because how many right shares will you issue? You already captured this. How many right shares have you issued? 2 lakh 50,000. I mean, from 1st April onwards, company will not have 10 lakh shares. They will have 12 lakh 50,000 shares. How? From 10 lakh shares, number of right shares is 2.5 lakh. So 10 lakh plus 2.5 lakh is how much? 12 lakh 50,000. Easy. From what day to what day? From what day to what day? From 31st March till end of the year. What is the year ending? 31st December. So from 31st March, you count from April, May, June, July, August, September, October, November, December. How many months? 9. So what you do? 9 by 2. This will give you your weights for the current year. This is your each, this is your weights. Dividing these two, you automatically get basic EPS. Got it. Not going now. Got it. Papa, last question. People are doing. All okay now? Sir, bonus is there. Bonus is there. Bonus only is getting captured to which element? Here to a fancy name. What is the fancy name? Adjustment factor. Whenever there is bonus. Whenever there is bonus. Last year EPS you need to restate. Now let's calculate last year the restated EPS. What is last year the issue? 20 lakhs. I mean we need last year the gains also. Last year how many shares we had? Only 10 lakh. Right shares came current year. Right shares came in current year. Last year how many original shares we had? 10 lakh. That's it. How we have to add bonus also. Bonus will be calculated separately or to adjustment factor. So what do you have to do? Take last year the number of shares and multiply by adjustment factor. Because the moment you multiply adjustment factor, what are you going to get? Original shares and bonus shares put together. Right now. So when you do 10 lakh into 1.04, what are you going to get? 10 lakh 40,000. That is original plus bonus put together. Last year 10 lakh shares was there from the beginning till ending. So what is the weightage? 12 by 2. Yes, right shares came only the current year. Yes, so last year we have the original shares how much? 10 lakhs. So what is the weightage? 12 by 2. If last year on original shares we are getting 12 by 12 weightage, on bonus also 12 by 2. That's all it is. So your each, this is your gains, dividing these two, you will get what? Restated last year the basic EPS. You have done 3-4 questions in a regular class. So if you are doing it for the first time, I suggest use this and once work it out on your. You'll find 2-3 questions in MEㅣCA material only of the sides. Yes, sir, people. Yes, sir, people. So if you want to express this step in numerical words, how can you express it, right? This one numerically in words if you have to express. What do you do? Just multiply what? Adjustment factor. That's what I've written in chapter. Multiply adjustment factor to existing shares before the rights issue. This way you will get the what? Original and bonus put together and then assign the weights. This multiplication you have to do only the current year or even last year. That's what I'm trying to express in words. Now we have multiply what? Adjustment factor, that's what I've written in the multiply adjustment factor to existing shares for the rights issue. This way you will get the what? Original and bonus put together and then assign the weights. This multiplication you have to do only the current year or even last year. That's what I'm trying to express in words. Now we have a number context to kind of connect with. That's it, sir. Right, so sir. What's the next concept, sir? Yes, sir. Okay, next row, so I told you about two types of EPS. Depth. Depth means basic EPS. Depth means diluted EPS. Now you are a hostel student, some of you. I don't have to talk about dilution for you. You have dalu sambar. You know what you mean exactly by dilution, correct? No. Diluted EPS also same. The word dilution means increase or reduction. Dilution simply means reduction. We are talking about dilution from what? Of what? EPS. So if EPS reduces due to a certain factor or due to some elements, that only we call it as what? Diluted EPS. Okay. So why will EPS reduce? Sir, EPS can reduce if you have something called POS. If you have something called POS, what is this? Potential ordinary shares or potential equity shares. If you have something called potential ordinary shares or potential equity shares, then EPS may get reduced. That reduced EPS only we are calling it as what? Diluted. That we are trying to calculate and trying to report it as depths. Okay, so we didn't understand. Yeah. Sir, potential ordinary shares means they are those shares. Currently they are not equity shares. But in future they may become equity shares. Currently they are not equity shares, but in future they may become equity shares. Example, convertible preference shares. Currently they are what? Preference shares. But when you convert it, become equity shares. That only we call it as what? POS. Convertible debentures. Currently what are they? Debentures. But when you convert in future, they will become equity shares. Such instruments only we call it as what? POS. Due to this POS, how your EPS will get reduced. Not only we are trying to calculate and show it as what? Debts. That means you are telling if POS is not there, is it not necessary to calculate debts, sir? Yes. If POS is not there, debts class separate calculation necessary, not necessary. If POS is not there, means debts so both will be same. If there is no potential ordinary shares, and basic EPS, diluted EPS will be same. If you have POS, then you need to calculate debts also separately. That's what we are going to do. Can we answer that? So how do you calculate debts now, sir? Sir, debts picks up from debts. Debts starts from debts. Debts ka formula after debts so formula what? E show by weight so. Okay, so in order to calculate diluted EPS, what you do is you already calculated each for basic EPS purpose. Take that. Start with that. Take each for basic EPS purpose. Add dilution adjustment. Similarly, denominator take weights for basic EPS purpose and add what? Dilution adjustment. Now, only extra fitting you need to worry about is what? Dilution adjustment. Dilution adjustment in numerator, dilution adjustment in denominator. That effect if you get automatically, you'll be able to easily calculate debts. Debts. So you understand this question of yeah. Give me one question. Just understand this dilution adjustment a little better. Okay. Anji, question. Question number 10 from our class notes. Net profit for current year 85.5 lakh. Number of shares outstanding 20 lakh. So if they don't give the dates, what is the assumption? If they don't give the dates, see, we want to calculate weights. If they don't give dates, what is the assumption? Because that's from the beginning till the end. If you want to assign weights, you always assign what weights? All you can also ignore. Because doing 12 by 12, not doing 12 by 12, effect is anyway. Same. Now, check this. Interest expense for current year is how much? 6 lakh. Income tax rate, 30%. Number of 8% convertible debentures. The moment convertible debentures comes, what do we call this as? POS. Potential ordinary shares. Currently, they are debentures, but in future, they may become equity shares. So, if POS is there, should we have to calculate debt separately? Is it required? Yes. How each debenture face value how much? 100. And how many such debentures we have? 1 lakh. And each debenture is convertible into how many equity shares? On one debenture, you have to give how many shares? 10 equity shares. And how many number of debentures we have? 1 lakh. So, how many equity shares you have to give? 1 lakh into 10 is 10 lakh equity shares you have to give provided you convert. Okay, that's the thing. In fact, if you remember in regular class, I always used to tell, always check the interest calculation. Always check the interest calculation. Interest is always calculated on face value. How many debentures? 1 lakh. Each for face value, 100. Multiply. How much is that? 1 crore. 1 crore is the total face value of the debenture. What percentage interest it carries? 8%. So multiply by 8%. 8 lakh should be your interest expense. The question says interest expense is only 6 lakh. What is the indication? This adjustment is not often tested, but you should always check in every question. Because it will have impact. What is the impact? Perfect. Sir, these debentures are not issued for whole year. These debentures are not issued for whole year. Because if you are issued for whole year, interest expense should be how much? 8 lakh. Interest expense should be 8 lakh. Is it 8 lakh or actual interest is only 6? I mean, outstanding interest is 2 lakh. No. So if that told interest paid is 6 lakh. Interest paid is 6 lakh. Then you could have said interest expense is 8 lakh. In that only 6 lakh is paid and 2 lakh is outstanding. They did not say interest paid 6 lakh. What did they say? Interest expense itself for the current year is 6 lakh. Okay? I mean, what? Debentures are not issued for the entire 12 months of the current year. It has been issued somewhere during the year. So you have to prorate. How? Very simple. 8 lakh is the interest for how many months? 12 months. Is actual interest 8 lakh or only 6 lakh? If 6 lakh is the interest means how many months? Prorate. 8 lakh is the interest for 12 months. So 6 lakh is the interest for how many months? Multiply how much I will get? 9. That means what? That means what? Debentures are issued in the current year only for 9. So do not forget, EPS is not straightforward calculation, it is weight based calculation. If you have issued the debentures only for 9 months, then weightage also should be assigned only for 9 months. That is a hidden adjustment. In some question they ask. In majority of the question, the interest that you calculate and the interest that is given in the question will match. There will not be any difference. So you have to worry about this calculation. If it doesn't match, you need to prorate like this and check. Sometimes it is asked. Majority of the times they don't ask. Okay, Naji. Pakka Naji. Anyone? Few seconds to class. Huh? Good. Okay, move on. Compute debts. So debts is very straightforward because all the data is given. So net profit means what? Net profit always means what? PAT. Is there any preference dividend here? If there is no preference dividend, PAT and each will be same. How is each? 85 lakh. So if you remember all basic EPS calculations, I used to present in this format. Same format I'll use for revision purpose. First, basic EPS. What is the each given in the question? 85 lakh, 50,000. What is the number of shares that is outstanding? 20 lakh. Date is not given. So worry about weights. If you want to assign weights, you assign what? 12 by 12. Or simply you can write 20. Because even if you wrote 20 lakh into 12 by 12, you will still get what? 20 lakh. Yes, sir, G. This is each G, this is Wayne's G. These two division will give you what, G? Basic EPS. Done now. So POS will not be considered for basic EPS, sir. No, basic EPS considers only existing equity shares. Basic EPS considers only existing shares. Diluted EPS considers existing and POS. Okay, so if the debentures already converted or will get converted in future? Will get converted in future. So that need not be brought in for basic EPS calculation. Okay, good. Now how do you calculate debt side second? How do you calculate diluted EPS? Take each for basic EPS purpose and add what? Dilution interest. Similarly, take Wayne's for basic EPS purpose and add what? Dilution interest. I mean, the only thing that we need to be aware of now is what? Dilution interest. Very straightforward, sir. What is this? Is due to POS, how your numerator and denominator is getting affected. That's all is dilution interest. Once again, due to POS, how your numerator, that is each, and how your denominator Wayne's is getting affected. That only we call it as dilution adjustment. First, let's do it for denominator. So if you convert, listen to this, if you convert debentures into equity shares today, what will happen? If you convert the debentures into equity shares today, what will happen? Number of equity shares will be same or it will increase? It will increase. Yes, sir. That only we are referring to as dilution adjustment. Here, check. How many debentures we have? 1 lakh. And one debenture is getting converted into how many shares? On one debenture, you will give how many equity shares? 10. On 1 lakh debentures, how many equity shares will you give? 1 lakh into 10. How much is that? 10. So if you convert the debentures into equity shares today, how much extra shares you have to give? 10 lakh equity shares. Okay, yes, sir. Correct. But ignore the weights or consider the weights. Was this debenture issue for the whole of current year or only 9 months? That means will you take 10 lakh or 10 lakh into 9 by 1? 10 lakh into 9 by 1. Understood, everybody? Because the debentures are issued only for 9 months. Correct. So how much will you get dilution interest? 7 lakh 50,000. Okay. That means what will be the weights for diluted EPS purpose? 20 lakh plus 7 lakh 50,000. How much is that? 27 lakh 50,000. You are ready with this number. Give you a few seconds. You understood why 9 by 12? What is the 9 by 12 again? Why 9 by 12 again? The debentures are issued in the current year for whole year or only 9 months. 9. Hence 9 by 12. Okay, now we have to calculate dilution adjustment on what? Each. If you don't want logic, simple formula is interest into 1 minus tax rate. No logic if you want it. Simply you have to do interest into 1 minus tax rate. First let's do that, then we will later. I into 1 minus tax rate. I for interest. T for tax rate. How much is the interest expense in the current year? 6 lakh. That is your I. Into 1 minus tax rate. Is tax rate given to the question? How much? 30%. 30% in full number if you express. It is 0.3. Do that. 6 lakh into 1 minus 0.3. If you do, you get 4 lakh 20,000. Right now. This is your dilution adjustment. What is this? Very straightforward. In fact, I'm giving you one big table tabular format. I proved it. You know, I don't have that much time. I try to explain it just 2 words. So if you convert debentures into equity shares, if you convert that debentures into equity shares today, interest company has to pay or they will save. Interest the company will pay or they will save. So when expense is getting decreased or when expense is getting saved, it means profit will be saved or profit will increase. Profit will increase. That's what it is. Okay now. Yes, sir. So when you do interest, so why do you do 1 minus tax rate, sir? So if profit increases, tax also will increase. Though you save the interest, 30% extra tax you have to pay to the government because profit increases. That means you are getting 100% benefit or only 70% benefit. 70% benefit. Because 30% who will take? Our Nirmala Sitaram ji. As what? Tax. So the benefit you are getting is not 100% but only 70%. That only is being expressed as 1 minus tax. Okay, Naji. So 6 lakh or 70% if you do, obviously you will get 4 lakh. This is the interest you will save if you convert the debentures into equity shares. Okay. So if profit increases means equity shareholders are sad or they're happy. They're happy, right? Their earnings will increase. That means what you should be doing for the dilution adjustment minus or plus. So take the each for basic EPS purpose and add what? Dilution adjustment, you'll get what? Debt star each. Adding these two, you'll get 89 lakh 70,000. This is the each, this is the Wayne's for debt purpose. Divide the two and you'll get what? These two you divide, what do you get? 3.2. That's your diluted EPS. Okay, people. But about this one last point you need to check. So dilution means increasing or reducing. So we are calculating diluted EPS. That means diluted EPS should be more than basic EPS or lesser than. Always check that. What is your basic EPS? 4.275. What is your diluted EPS? 3.6. That means it is diluted. Some cases you'll get anti-dilutive. You'll get anti-dilutive EPS. Such questions are not there in your intermediate. They'll come in your final degree. There's something we have to do some ranking order which we will teach you in 5. Is it okay? But do remember if you get this one, suppose by chance you get 5. Suppose you get this number as 5. You will simply say it is anti-dilutive, not anti-dilutive. Proper words. You write what? It is anti-dilutive and say it is not reported. Okay. Mostly it will not come just saying. If I say it is that this. Mostly it will be dilutive. Now, okay. Now what's your name, sir? Ashik is saying, sir, what if it is convertible preference shares, sir? You guys tell me, sir. You will answer this question. Instead of convertible debentures, if it is convertible preference shares, what will happen? Sir, interest is an expense. Interest is an expense. Due to that expense, tax will get impacted. When will you pay preference dividend? What's the order? From EBIT, if you reduce interest, you will get earnings before tax. From this, if you reduce tax, you will get earnings after tax. Then only you will pay what? Preference dividend. That means tax is already paid. Tax is already paid. Preference dividend will it have an impact on tax or no impact? No impact. So if convertible preference shares is given to you in the problem, will you do interest into 1 minus tax rate or only preference dividend? Only preference dividend will be dilution. Got it? Okay, everybody. And this will be same. This much. That's a good question. Thank you. You saved me one extra question. I explained no. Sorry. You've done such question. You've done regular class. Just I didn't have time, so you made it cover. So awesome. Good point. Thanks, Mr. Ashik. Ashik. Okay. Oh, people. This one. Need more time. Need more time. Got it. Got it. Got it. Fully got it. Fully bounced. Okay. So this is over. What else is there? I think I would like to do one more diluted EPS question. And one concept is there. One question is there. Over. Last one. This topic one. Okay. You have something called share warrants here. Oh, no, that is not there. Syllabus. Look, no, I tell you. Sir, it's a usual practice for the company to give shares to their employees. Right now. It's a usual practice for the company to give shares to their employees. That only used to call it as ESOP. Earlier, this was part of your inter syllabus, and I don't know why they removed it. But you can't escape it. It's there in CA finals in days 102. It'll come. If it was there, you're only going to be better. But anyways, no problem. Now, this will have an impact. Now, people, when company is giving shares to their employees, when company is issuing shares to their employees, do you think they will issue the shares at market price? No, they will issue at discounted price. And shares will be given immediately? No, company will tell the employee, you first work in my company for 5 years. Then I will give you shares. So what is the company telling? Company and employee have made an agreement. What agreement? Company will give shares at a discounted price to whom? Employees. When? Today or after? In future? Future means it is basic EPS or POS? Yes. So ESOP also is an example of what? Yes. If such things are there, how EPS is going to get impacted is what we are trying to calculate. This question is also very important. There's a formula, there's logic, both the method works. Okay. I'll tell you like, the logic method, easy to remember. The formula here and there you can do. Logic will work in any case. Look at this. Steps to you need to calculate. Net profit for the period is 10 lakh. Net profit for the period. Net profit means what? Pack. If there is no preference dividend, pack and each are same. How much is it? 10 lakh. Weighted average number of equity shares outstanding 4 lakh. Such a nice problem. Whom problem is this? Because they only given weights. We have to calculate or given. How much is basic EPS then? Issue Wayne's. So issue Wayne's. How much is basic EPS? 10 lakh divided by 4 lakh, 2.5. Basic EPS 1 line. Yes, sir. See, even if you don't know this question, at least put basic EPS now. In 4 marks you'll get 1 mark. That's the difference between getting 39 and 40. 149 and 50. So just because one question is new, don't say going there. Read the question once. Some part you may know, some marks you may get. Invigilator may come point, say you've written something, let me give him 1 mark. All that matters. Okay, don't completely skip anything. Okay, this is done. Next. So check. Weighted average number of equity shares under option. Which option are you talking about? Please. How much? 2 lakh. So totally you've given an option to the employee to buy how many shares? 2 lakh shares. So the average price of the equity shares is how much? Average market price is 25. Do you think company will issue the shares to the employee at 25 or less? How much? Exercise price of option is only 20. Take a calculator, Guruji. How many shares are issued to employees? 2 lakh. That means how much money company will collect through the shares. To this case of total, how much company will collect? 2 lakh shares, and on one share company will collect 20 rupees. So total proceeds is how much? 40 lakh. This is good. Nanji. Now people, let's assume that you are not employee. You are not employee. You are a normal third party. You have how much money with you? 40 lakh. And you want to buy this company ka shares. You want to buy this company ka shares. What is the average price? What is the average price of one share of this company? 25 rupees. So you have 40 lakh rupees with you. You have 40 lakh rupees with you, and the price of one share is how much? 25 rupees. How many shares can you buy? You have 40 lakh rupees with you, and the price of one share is 25 means how many shares can you buy? Ideally, how many shares can you buy? 1,60,000. Correct? That means company should have given how many shares to their employees if they had issued the shares at a fair price? They should have issued only 1,60,000 shares. Correct? But did the company issue 1,60,000 shares to their employees or 2 lakh? 2 lakh. The number of shares actually issued under this option is 2 lakh. How much should have been issued? 160. How much is issued? 2 lakh. That means how much extra shares are given? 40,000. I mean, on this 40,000 shares, company collecting any money or no money? I'm not only calling this what options issued for nil consideration. Meaning shares are issued, consideration received or nil consideration. Meaning company has not received any money on how many shares? 40,000 shares. Correct? Now, how this 40,000 shares impact your EPS is what we're trying to calculate. Now, how this shares impacts your EPS is what we're trying to calculate. You agree with me? Okay. You already calculated basic EPS. So this is what you have to do. Simply add what? Dilution adjustment. Sir, has the employee already purchased the shares? Has the employee already purchased the shares or in future? Future. So that means is there any dilution adjustment on each due to this? If it is convertible preference shares, convertible debentures, you already accounted. You already accounted for preference shares. You already accounted dividend. Preference dividend. For debentures, you already accounted interest. That you can save. For options, what have you accounted? Nothing. So what is the dilution adjustment of this on each? Nothing. Zero. Okay. But is there any dilution adjustment in number of shares? Yes. How many shares you are given for free? 40. This is a value or number? Baines captures value or number only? Number. So that means the dilution adjustment is what? 40,000 shares. So what is the total Baines for debts purpose? 4 lakh plus 40,000 is 4 lakh. 40,000. This is your each. This is your Baines calculated debts. 2.2. Lastly, you will check. What you will check? Basic EPS and diluted EPS. You will compare. Diluted EPS should be higher or lower than basic EPS. Lower. Is it lower? Yes. That means what it is? Diluted. You don't have to comment like, but check all this stuff. Because if it is anti-diluted, you will not report. In that case, what to do? I will tell you the next one. This is your debts. Another question which normally comes in examination.